we've covered some basics, understanding auction market theory, covering the importance of gaining understanding and understanding balance and imbalanced markets. So just covered some of the characteristics of balance and imbalanced markets. I've also covered the concept of acceptance and rejection. Now, I want to just start applying some of this stuff and the knowledge that you've just gained and which I've just shared in a or how would you apply it in reality? How would you practically apply what you just learned? How would you practically apply looking for low volume and high volume, understanding what it means? Well, as I started to discuss, we can use the volume profile. We can use the volume profile. It shows us where acceptance and rejection is, where high volume has occurred and low volume has occurred. We can also use value to identify when prices are within areas of key acceptance, and also identify when prices are outside of key areas of acceptance, and advertising at wholesale and premium prices, therefore providing opportunities. So some of the basics have been explained. Now, how would you go about looking for key high and low volume areas on your charts? Well, the basic concept that I use is to look at a daily chart. So it doesn't matter what market it is, but for intraday trading, or maybe even for short-term swing trading, you could use this method. Okay. Of course, it actually could apply to multiple time frames. So because we're gonna actually get some key longer term acceptance and rejection areas. So we're interested in over quite a key period of time and a wide period of time. Where have we mostly accepted and rejected? Which prices have we mostly accepted and rejected? Now, there's a very easy way to do this. Look at your daily chart, and in this case I'm looking at the E-mini S&P, which will be the market of my choice throughout the webinar. And if there are other markets that you would like me to look at, we can always look at them, but for the moment the major focus is going to be E-mini S&P. These concepts apply to any time frame and any market, so it is universal. I just want you guys to understand how to apply this. So doesn't matter what market it is, what you want to ask yourself is, where is a key high or low that we are trading back towards on a longer time frame chart? So in this case I'm looking at a daily chart. Of course you could use a weekly, it doesn't matter, because the daily weekly charts are only going to define when the bar opens and closes. It's not important. When you are doing volume profiling work, it's really important to understand that the actual time frame is not important. Whether this is a daily chart, whether it's a 30-minute, 60-minute chart, or whether it's a 5-minute chart, if we go back to the same time, the volume profile levels are going to be the same, because we're looking at volume. So the only reason I use the daily chart is it allows me to go back long enough or far enough for me to get an idea of where we are from the bigger picture. So from the bigger picture, well, initially we was trading back to these lows in 2010. So we had this low as a key area and this high as a key area, and we're sort of trading back towards that. So really I'm interested in where are we accepting and rejecting in between this swing low and this swing high. So I want to also understand what has been accepted and rejected in that swing. When we broke out in 2010, we then started to take into consideration this high to low. So I mean, this is building in real time, so the market will keep building, and the profile will automatically, if you set it up the right way, this is the way that I set it up, so take from this low to high, as the market builds from one day to the next, it will keep moving across like so. So that will keep moving across from that low. Now recently we took out the 2011 highs, and although you can still use the 2009 low as a key level, I'm also now interested, because we haven't reached the 2007 highs, what areas of acceptance and rejection might we be testing back into those highs? So what I'm interested in at the moment, and there is no right or wrong for this, is what prices have been accepted and rejected from that swing high up to the present moment, which takes into consideration this low and everything else in this range. So at this current moment in time, I've actually got the 11th of October high as the place where my profile starts. Okay, the way you do that is to firstly just take a mental note of that high. Of course, you could also go back to this high if you want to take into consideration this range. It doesn't have to be perfect. There is no right or wrong way to do this, but this is just how I do it. Okay. So if I'm interested in what price were accepted and rejected since that high, including this low and up to where we are right now, in all of this range, I need to make note of this date. So once I've done that, I then move to my longer time frame chart, which is generally where I do my analysis and figure out where I'm going to be looking to buy and sell. I then start this chart from that date that I've picked off the daily chart. So I begin this chart on the 11th of October 2007, which is that major high, and then I'll leave it set to build up until the present moment, so it's always live. Okay, so that's this chart. It starts in October 2007, 11th of October 2007. That's just this chart. Okay, it doesn't define the profile. Now, if I was to draw a profile, it doesn't matter where I take it from. I can take it from this low to high. I can take it from anywhere. I can draw it from this low, anywhere. Just draw a profile. It doesn't matter where it starts and where it ends. What you then do, once you've drawn that profile, let's get rid of these value profiles for now. So what we're trying to do is establish key levels for doing business at. Okay, and the way to do that, just going back, you go back to your daily chart or weekly chart, a longer time frame chart, pick a key high or low for that market that we may be trading towards. Now, once I've drawn a profile on this chart, and I've set this longer time frame chart to begin and start at that major high for the mini S&P, I can now set this profile to take into consideration all of the volume that's traded for all of the bars on this chart. So you go to the time per profile section and you change this to all bars. Once I do that, you can see this profile will now span over the full time frame for this chart, which would automatically go back to October 2007, 11th of October 2007, and right from that day up until where we are in the present moment, it will show me where rejection and acceptance has occurred. Now that's useful information, right? If we understand what can occur at acceptance and rejection areas, right? Does everybody agree? Now you can go back as far as you like, as long as you can download the data up to that date. Right, so we're now looking for some key levels, key areas for doing business. So, is there any questions about that? Does everybody understand how to do that? It's the same for any market. Just pick a major high to low, then you set a longer time frame chart to start from that date, and then you draw a profile for all bars. Right? So what that then does is give you a profile showing you key high volume and low volume areas up to that date. Okay, good. So now, Market Delta can give you the opportunity to draw these levels automatically, peaks and valleys, etc. Okay, so the red levels are the low volume nodes, the grey levels are the high volume nodes. So basically what it does, it gives us our key support and resistance areas to do business off on a daily basis. Now you can take that off and you can find the areas yourself. Okay, you can change the profiles. Does anybody not use Market Delta here? I take it everybody uses Market Delta, but or Investor RT. Okay, now if you don't, you will need Market Delta to do this, or Investor RT. And to use the order flow stuff that I do tomorrow, you will need Market Delta. So you can use Investor RT if you're not going to use the order flow, because it's pretty much the same software. Market Delta is basically a white labeled version of Investor RT. The only difference is Market Delta allows for you to use the footprints, which actually I use. So if you plan to use some of the stuff that I share tomorrow, it's useful to have. Okay, so if anybody doesn't use Market Delta, do take into consideration you can use any piece of software to do this stuff, as long as it allows for you to draw more volume profiles. Now I'm only showing you how to do it in Market Delta because that's the software that I use and most people use. Okay, so if you have any questions and you're not quite sure to do it in a different piece of software, you know, you can always ask me. I'm not quite sure how you would probably do it, but I can probably figure it out for you. Okay, so there are other pieces of software that you can use to do volume profiling, but I recommend Investor RT and Market Delta. They're probably the best piece of software, and also give you the opportunity to or the ability to use a lot of tick data and minute bar data. Yeah, absolutely, you can. Well, we have been. So there's a vacuum of low volume there, as you absolutely pointed out there, Ben. So what you can do, because you can see here, this is difficult to make out because it's quite dark. This is on a heat map profile shading, so you can actually change the level of shading. You can change the color now. You can change that to red, green, blue. Doesn't matter. Now, for the moment, let's just put it on, say, green. Okay, so you can see it stands out. So now in this situation, what you'll find is this volume profile. Now this is probably going to more advanced volume profiling stuff, but it's not really that advanced. But for some of you guys that are new to it, basically you can widen the profile and you can make it thinner by changing the width here. Now you'll have a default width to the profile. Now when you get to these areas where it's quite low volume and you can barely make out what's high volume and low volume, the trick is to change the width. Okay, and I usually shift it to around 500 pixels wide. Okay, and you just widen it up as much as you need using this setting here. So you can change it up and down. Okay, so you know we've got some areas up here. Now I can quite easily eyeball some of these levels and say there's a low volume area. So I can eyeball this and say there's a low volume area. There's a low volume area. So this whole section looked like a low volume area originally, but there is actually volume still traded in there, going all the way back up until 2007. So you know we can start manually taking those levels, which I like to do, or you can use the software to just show you automatically where the peaks and values are, and that might be a bit too many levels, but there you are. So then it will give you the red levels are the key areas that you're interested in. Now you don't have to thicken the profile to do that, because it will sort find them. If you do this, I think it does. Yeah, so it still finds them if you have it on the automated setting. But if you change the width, it's easier to see. You can see low volume area up here. So you know, like the E-mini S&P right now, we can see it's right at this key area of acceptance. Right here, we're just sitting below it. So we can see that there's volume drops off just above it there and above it here. Now that the automated tool doesn't pick that up, volume drops off here and above all the way up here. So these will be key levels if we're looking at just blindly selling levels above the current market price, or this low volume area here, this low volume area, this low volume area below us. Now this is where value comes useful, because we can say to ourselves, this is how I trade these levels around value. I said, okay, value occurred here from this beginning of this range up to here. So I now can say to myself, for trading a balanced market, which is what I would normally do, and this is what I would recommend most of you guys focus on doing, say to yourself, okay, we have value here between 67s to 1354s. So 1354 to 67 is an area of value. Anything in the middle of it is fair prices. The best opportunities for us are going to be outside of this range. So we can sit here and say, okay, now we have an area to look for selling at 72 halves, and the next low volume area above it, which is 76 quarter right there. Okay, and then above it 1382s. We don't obviously want it to extend too far away from value, but we want it to advertise above value. So when it gets to these areas, we can even say right from this moment in time, if the market gets up here, we can be focusing on shorting this market from this level, and this level. So we already know where we should be looking to do business and looking to sell above value. Why do we want to sell above value? Because that's where it's going to be unfair for the buyers. Now the buyers may well take the price might well get up there, and buyers might start accepting. This is where the concept of acceptance above value comes into play. If we see this volume distribution start to build like this, then we can start saying to ourselves, okay, we better watch out. Okay, but however, if we get up here and this volume distribution doesn't build, and we get up here and price advertise, and we still see lack of volume building up there, we can quite comfortably say, okay, we're still rejecting, and that might happen over a day or two. Okay, we could quite comfortably saying, okay, as long as it's rejecting up there, I'm going to be looking to short this. Not only will you know that you'll be looking to short it, you'll be able to say, I'll be looking to short this from here down to 54s. Why? Because the typical rotations for the market in a balance phase is from above value to below value. From below value, so if we get onto the other side of value here, it will be from below value back to above value. Okay? We see this has already happened. We already tested this area, rotated back down, traded below value, tested the low volume area on the other side, traded back up, traded the low volume area on the other side, traded back down, traded the low volume area on the other side, so we'll push back up. Then we got through the levels with that sell-off. Okay, now you use the order flow to define, and the price action there to define when to take those trades and when not to. Now I stayed out of trouble in this move down. I took one long and I ended up getting my first target, and that was it. But it keeps you out of trouble, so we're not just going to trade the levels blindly. Remember that. Remember that right now, that we are only establishing where to do business. Where might there be an opportunity to do business? It doesn't necessarily mean you're just going to go and take a trade there. Okay, so please do make a note of that and understand that right now. That these areas are areas of interest, areas where when the market gets there, you'll be interested in trading. But not only will you be interested in trading, you'll know ahead of time what you'll expect to happen when the price gets there. Does that make sense? So the key concept of value markets trades around value and accepts what is likely to happen. The market is likely to just trade sideways, at least until we accept outside of that range, right? So understanding that, how would you apply that understanding? You'd say to yourself, okay, let me find an area of acceptance, which we do with value. Okay, and then you highlight your areas of rejection above and below value, and then you can say to yourself, when I test a rejection area above value, I'm going to be looking to short it. When I test a rejection area below value, I'm going to be looking to buy it. Obviously with confirmation, with something happening there to give you that idea, or give you something to say that, yeah, this idea might be right. Okay, so we're only looking at the idea right now. This is just ideas. We're developing ideas for trading around. Okay, so this is all we're doing. Step 2, identifying opportunities based upon step 1, where we've just understood the market structure. So the markets, as we know, are likely to balance more than 80% of the time. We see that all the time. You've only got to look at your daily and 30-minute charts there. And that therefore tells us that there's a very good chance, if we focus on selling above value and buying below value in a balanced phase, that those trades are going to come off. Okay, somewhat. There's an opportunity for that move to happen. Okay, doesn't necessarily mean it's going to happen and exactly the way you think it's going to happen, but at least you know there's a chance. You have an idea. You have an expectancy based upon logical understanding of market structure, understanding the basics of auction market theory. Okay. And also at the same time, from applying what you've just learned, you also understand that volume profile will tell you when we are actually accepting outside of prior value, and will tell you, okay, to be aware. Okay, maybe stay away. Now we actually saw a push down here. Okay, and you can see how the volume built down here because I left that building. And you could start to see that volume start to build down here, but it wasn't nowhere near as significant as the amount of volume down up here. So when I say volume building, this might be a heads up, and only a heads up that we're starting to accept down there. But when you compare the amount of acceptance down here to the amount of acceptance we had up here, what looks more important to you? What looks more important to you as an area where we found acceptance? Obviously, we might spend more time down here, and that could have well happened, and continue to build that distribution. But for the moment, if you look at that, we had some volume down there. It's nowhere near as significant as what we had up here. And the fact that price starts to move away from this you should automatically be thinking we're coming back into this area. Okay, does that make sense, guys? So I mean, if we was coming to this market on Monday, what are you going to be looking for from just understanding the basics right now? Balanced market. What will I be looking for? I mean, actually, I already explained this in the trading room on Friday, and we had an area right here, 69s, to watch out for. Now we can take this one step further. Okay, look at the daily chart first. If you look at the daily chart first, you already understood that we've been accepting around here. Basically, it's the same thing we're looking at, but it's just from a slightly wider perspective, from a daily chart perspective. I'm gonna cover the fib extension. So swing low to high here, got a 1272 extension down here. So that's what we call a discount wholesale price. Now, if you look at the daily chart, there's hardly nothing down there. Okay, when we traded down here, most of the acceptance is up here. I mean, that was a heads up for us last week anyway. We're already back up to it now. Okay, so from looking at the daily chart, we can understand what's going on there. But from the daily chart, we can also see now that we're coming to this key area here. Let's just got to draw a composite profile on here. Now, on the daily chart, I'm just going to take into consideration all bars. And on the daily chart, normally about 10 years back is enough. So what we've got here on the daily chart, again, just if you look at the red lines, what's a key area for us to test on the daily chart? 71s. Okay, but you know, this whole area here is a key area of rejection. So we look at that, we can say to ourselves, okay, 71 is a key area to test. But you know, we're above value here. Low volume is pretty much this whole range here. So although I do talk about low volume nodes, do consider these as areas for doing business. Okay, low volume areas. We might hold it anywhere in that area. Right, so now we can establish that from that time frame and say, okay, we've got a key rejection, we're advertising price higher, we've got a key rejection area above value here. It's a pretty wide range from 75 down around 70s, 69, so it's about a 6-point range where we might find some rejection. Now from a longer time frame perspective, rejection could be occurring whilst we're trading in that area. Okay, however, these LVNs are normally quite accurate, so do watch out for what happens around an LVN, a low volume node. Now when we move to the next time frame, we can then sort of drill down and become a little bit more accurate with our analysis and levels. So we can then move down to here. Now this is the automated levels, but what I would normally do is take these manually, and I would recommend that you actually do the same, because it gets you into the habit of eyeballing low volume areas and high volume areas manually, rather than relying on something to do that for you. So I can sit here and say, okay, we've got some low volume up here. We've got some low volume areas right here, 72s. We've got some low volume areas that stand out at 76s. So I can say, okay, we're above this big value area. Okay, we've been in that for quite some time, so we could, you know, clearly market participants have shown they're still accepting that range. And if I'm expecting longer time frame sellers to do business up here in this range again, where should I be focusing to get short? This is where you can establish your levels. You can say, okay, 69s, I'll be focusing on reading the order flow there. 72s, I'll be focusing on reading the order flow there. 76s, I'll be focusing on reading the order flow there. And those would be your areas for doing business, for entries. But at the same time, knowing if it starts to come off, you've got firstly a very good chance that it's going to come back to the point of control, which is the fairest price. So if the market rejects above value, rejects above an area of acceptance, where does it come back to? It comes back in an area of acceptance and usually reverts back to the point of control, the mean, the average price. And very commonly we'll see the market will go to the other side of value. So normally what I target as my final target or my major target is the other side of value. So if I'm trading around this value area on Monday, which is probably what I'm going to be looking to do, I'll be looking for some bounces into this area, and I'll be looking at, okay, I want to target 51s as my major target, and on the way down I'm going to be scaling out and taking profits. Okay, so you know, that's the way we've been approaching this range most of the time. You know, it's obviously the basics of looking for opportunities around value and a balanced market. So this market is clearly balanced, so that's what you should be doing. So you should be looking for key rejection areas above value to short it. You're not even looking to buy up here unless you move to the smaller time frame, but there's no reason to, not until these levels get broken. I find it much easier myself to focus on doing one thing, which is trading responsibly above value and trading responsibly below value. Now you can adapt and you can say to yourself, okay, this market doesn't look like it's finding the sellers above value, and I'm going to start looking to buy the pullbacks. Now I've covered this before in previous seminars, and do recommend that you adapt if it's very clear. But if it's not clear in balance and it's not that clear that we're not going to continue higher above value here, you're better off just focusing on responsive trading. If it doesn't look like it's not going to set up here for shorts, then just don't take the trades. Just pass them. Okay. The reason I say that is because for newer traders, and when you're getting used to trading this way, if you try to do both, it can become a little bit confusing, and you might fall into the trap of, okay, should I be trading responsibly or should I be going with? Should I be looking to buy? Should I be looking to sell? And the easiest thing to do is just say, okay, what happens more often? More often you're going to find that there are going to be responsive sellers above value, you're going to find the responsive buyers below value. So let me just focus on that. There might be days where I don't have the trades that I'm looking for, but most of the time I'm going to get the trades that I'm looking for, and they are going to be the better risk reward trades. Okay, it's just like, we had this move down. I could have jumped on board that short move, okay, but most of that happened in the European session. I left it. I said I'm going to focus on the long side. That's the only thing I'm going to focus on. I'm not even going to consider going with this market lower, because I'm thinking we're getting into these wholesale prices. Longer time frame players are going to come in and cut that off, and we're going to come all the way back up again. So I'm going to keep focusing on what I feel is going to be the potentially bigger move and trade around that. So yes, you can adapt and go for those imbalanced moves, but usually they're short-lived, and usually they last for that day, and very rarely continue into the next day. But most of the time, trend days last for one day, and then the next day they balance again. So if you find that the market is trending through those levels above and below value, just most of the time you just want to let it go. Okay, and that's probably the easiest thing to do, firstly. So let's just review. We've covered finding a balanced market, sideways price action, most avoiding trading in the middle of the range. We have a key area of value to trade around. What are the opportunities? Step 2, focus on finding low volume areas above value to short. Focus on finding low volume areas below value to get long at. Very simple, yet very effective. That's all you need to do, okay, for finding opportunities. That should be everyone's level of focus going into each trading day. Now, most days you're going to find balance to trade around, okay? Generally, I focus on trading wider value areas, which I feel are evident on, say, a 30-minute, 60-minute chart. Something that I feel there's good risk to reward around. Okay, even if I can get part of those moves, I'll get a good trade. Now, on the E-mini S&P, I'm happy if I get a 7 to 10 point move, and that's normally, what I'm looking for. And that's 30 to 40 ticks, 35 to 40 ticks. Okay, so in a nutshell, that's the basics of trading around balanced markets. Now, in imbalanced markets, let's say you do find that you want to trade the imbalance that's occurring on an intraday perspective. You basically do what I pretty much showed on the daily chart there. Now, on the daily chart, if you do want to trade in the direction of the trend, the best thing to do is, get this daily chart, recognize which way it's moving, focus on trading only on the upside, but off key low volume areas in that direction. Okay, you can see most of the time we're testing these low volume areas. Now, another way you can do this, rather than using one of those composite profiles that takes into consideration all of that data. So if anybody's not quite sure, a composite profile is a profile that takes into consideration a wide number of days. Okay, it can be for a week, it can be for 2 weeks, it can be for 2 years, 3 years, as long as you like. As long as you're looking at a wide range where multiple distributions have occurred, that's the composite profile. Now, you can also take micro composite profiles, and for example, like on the daily chart, like I did earlier, let's just say you just want to focus on trading in the direction of the daily chart trend. Okay, so it's clearly making high highs, high lows, so you want to focus on that side. Now, obviously, you're not going to be taking some of the good short trades that are going to be setting up from one day into the next, but at least you'll be trading in the path of least resistance. Now, I personally don't do that. I just trade around value off my longer time frame chart. I ideally do want to get involved in the trades that are in direction of the daily chart, but like I said, the daily chart's been balancing for a couple of weeks or so and then continuing. So we've had some nice balanced phases that have been very nice to trade around on both sides. But the path of least resistance still, for the moment, is still upside on the E-mini S&P, as we can see. Now, if you get a composite profile tool and take it from this low to high, and again, you can leave that building to present, so it's building in real time. If you want to trade with that trend, and this again could be done on any time frame, is to focus on finding key rejection areas. But only focus on trading in the direction of the trend. So if the trend is up, we're making higher highs, higher lows. Buy pullbacks to low volume areas like this. Okay, we've got a low volume area here, and we've got this is still a low volume area. Okay, right here. So that's how you would apply that in an imbalance phase. Now that's the daily chart. You can also do that on a slightly shorter term perspective. So here's the last bit of trending action we've been seeing here, and leave this building in real time. The levels will present themselves as the market continues to move in that direction. Now you can see from this low to high, where did the market pull back to? Low volume areas, the red levels, those are low volume areas. Now you can take those manually. I'm just showing you this to make things simple, just letting the software take the levels for me. Okay, low volume area, pull back. Okay, so next high, where did we pull it back to? Okay, still that low volume area. Next low to high, we had some volume up here. Not a lot of volume up here, but you can see there's no volume here. Okay, so we held that, no level there taken by the software, but you can definitely see there's no volume there, low volume. Okay, you can see even if we don't extend this, where did the market come back to after that? Low volume area, low volume area. Can you guys see that? Does that seem evident? Can you guys see that? How it's just sort of pulling back to low volume areas, key areas of rejection, and then continuing the trend again. So, if you are more of a trend trader and you prefer to trade with the trend rather than trade responsively, you can still use what I am teaching you here. Okay, but you just apply the tool in a slightly different way. Okay, so there is nothing wrong with buying the pullbacks and selling the bounces and trend trading. Some of you will prefer to trade that way, and some of you will prefer to trade around balance and around value. So what you have to remember is neither of them are wrong. This market is trending up here from this perspective, and a trader that's looking at this as an uptrend is right to buy the low volume areas here on pullbacks if that's their focus. Okay, and it's actually a nice simple way to trade. Where's the next place to buy in this trend? Well, it's right there, 65 quarter. Okay, obviously you're going to look to see what happens in that area. Let the market prove that it's rejecting that area. Watch price action, watch order flow, and the stuff that I'm going to share tomorrow. So this is just identifying the opportunity. Where might you do business? Well, if you want to buy pullbacks and you want to trade with the trend, you take the last high, take it to the take the last low, up to the last high in the current trending market phase, and you look for pullbacks and keep trading with that trend. So you can apply volume profiling to trend trade as well. What you have to understand though is from a market, more of an auction market theory perspective really, is that the markets are balanced most of the time. So even though we did have a trend here, do understand that now we are getting to a point where we probably will stop. So even if you are going to trend trade, it's okay. You could sit here and say, okay, I'm going to buy from this area all the way up to this area, because I expect this market to trade around this balancing range and be able to go from this low up to this high. And as it's making higher highs, higher lows in this phase here, I continue to look for pullbacks to low volume areas. So you can actually trade with the trend, but with an understanding of the context of a balanced market. Does that make sense? Because at the end of the day, what is the market doing when it moves from the value low to the value high? From the value high to the value low? It's still moving in that direction. And somebody that's looking at just that swing will say that market's trending. Right? But it's usually trending within the context of something. So what I want you guys to see here is, even when the market appears to be trending, especially on an intraday basis, it's still trading around these ranges. So, you know, even when we had this big move down, it's still trading around this range. When we had this big move up, it's still trading around this range. Right here. So you can trade understanding that. You can trade knowing that. If you firstly understand the context within which you are trading and understand the simple concepts of acceptance and rejection. So what I'm trying to show you guys here is that you can be creative with the level of understanding that you are gaining. If you can understand the concepts of acceptance and rejection, can you guys see how even just using the volume profile tools in a variety of different ways, you can be quite creative with it. There's not just one way to use it. Does that make sense? Because I often get the question, you know, have I done this right? But the question should really be to yourself, you know, does it make sense to you in the way you've just applied that tool? Okay? Because to know how to apply the tools, you have to understand what you're doing. You have to understand what you're looking for. So really you shouldn't have to ask anybody, have I done it right? Because there is no right or wrong. What you're trying to do here is, okay, saying to yourself, okay, I understand the concept of acceptance and rejection. I understand the auction market theory principles. I understand there's a tool that I can use, the volume profiling tool, that shows me where acceptance and rejection is occurring. Now, really and truly, there's no right or wrong way to use that. I could sit here and say, okay, I don't want to take the high of October 2007. I just want to look at the last 100 days. Now, does that make my profile wrong? Anybody? Does that make my profile wrong? No, right? It's just the way that I wanted to use it. Right, so I want you guys to see that there is no right or wrong way to use this. I am showing you some of the ways that you can use it, and that's exactly right, James. As long as it makes sense to you, okay? As long as it makes sense to you, and that's the most important thing. Does it make sense to you what you are doing? So whenever you put these tools in your chart, you've got to say to yourself, okay, I'm doing this because this is what I feel may happen. This is what I see happening. This is what makes sense to me. So it doesn't have to make sense to me. It doesn't have to make sense to anybody else. As long as it makes sense to you. And the only way it's going to make sense to you is if you understand, firstly, the basics of the auction market theory principles. You understand acceptance, rejection. And then you understand that these tools just help you apply that level of understanding. So you can start to see why I was talking about understanding before. And if you don't understand what you are looking at and why you might even be looking at it, if you don't get that part of it, you're not going to know how to use the tools. Because if you just say to yourself, okay, I'm going to put a tool on, I'm going to put it on my chart, this is the way somebody else uses it, that's the way that I'm going to use it because they use it that way. It's not, it's not really the right way to do it. Okay? It's not really the right way to do it. So what I'm trying to give you here is some ideas. Okay, understand acceptance, rejection. I want you guys to be able to say, okay, all right, I'm going to trade this trend. Let's have a look where we got some. I'm going to buy some pullbacks in this trend. Okay, let's see where we got some rejection areas. Okay, then the next person here may say, okay, I'm not going to trade that trend. I'm looking at a bigger move here. I'm looking at, okay, this market may potentially get up here somewhere. We might reject, and I'm going to look to play this move all the way back down to say 1340s, 1335s. How do I take advantage of the opportunity, and how can I find where I might be able to do business? And then you'll say to yourself, okay, let me draw a composite profile, take it all the way back to some major highs in 2011, which I've already done, 2007, sorry. Let's have a look at where there are some key rejection areas above us right now. Let's have a look where value is, okay, because I understand that value shows me where the market has been accepted, and therefore if we're getting above that area, we might well come back into that area. So there we are. Okay, I'm going to trade responsively. I'm going to trade it back down from these areas. Now, just because this trader here is trading responsibly and trading it back down doesn't make the guy that's sitting here looking at this upwards trend, looking to buy the pullback, wrong. Right? So there's no right or wrong there. It all depends on how you want to trade it. Okay? It all depends on how you want to apply it. So that's the first thing. That's why I said don't look at this as a system. What I'm going to teach you is a way of understanding the markets and how to use some tools to help you understand the markets and what's going on. Oh, Ben, let me just see your comment here. From what I have learned, using custom profile around recent price action is the most useful. Is the recent price action is the most useful, and then look for LVNs on the composite that coincide with the value low, value high. Yeah, absolutely. For responsive trading, that's pretty much the best opportunities. Yeah. So, I mean, the way that I look at it is I look at it from usually a 30-minute, 60-minute perspective, and I trade it this way. But it doesn't necessarily mean you're going to apply it in exactly the same way. You might be looking to apply this on a more shorter-term perspective and say to yourself, okay, I'm going to trade a 5-minute chart. Not necessarily 5-minute chart. You can trade a tick-based chart. You can trade a range-based chart. Again, that's all personal preference. So you can sit here and say, okay, I've got a 5-minute chart. Now, somebody that's looking at the 5-minute chart will have a completely different perspective of what value is and where they are trading. So you look at a 5-minute chart now, all of a sudden you have no idea where or you can if you come from the top down. But let's just say we have no idea of where that wider value is or that we are at a wider value at a high. Then you can say to yourself, if you want to trade some shorter term moves, that, okay, I'll trade around this range, okay, or I'll trade around this range. You can say to yourself, I'll trade around this range. It's the same concept. Still volume profiling, still key acceptance and rejection. Now, if you have a look at what's actually been happening here around these ranges, there's a distribution, there's a distribution, there's a distribution. So there's 3 distributions here in this range. Actually, there's one here as well. But, you know, where does the market reject? Looks to the right, low volume areas. Where does it reject before rotation back down? Low volume area. Where there's a pass-through rejection there. We got through. Where did it reject above us? Okay, it doesn't have to hit it to the tick. Where is it rejecting? It's rejecting this area right up here. Okay, push it back down. Okay, and then we get through this low volume area again. Where does it start to reject again? It's bouncing around between 2 LVNs. So it can be applied on any time frame. Can you guys see that? It's very much the same concept, right? That's just more on a micro perspective, looking at 5-minute balancing ranges. It's the same thing though, right? It's still rejecting the low volume areas above and below those ranges. Does anybody not see that? Now it might be easier if I make this profile a bit thicker. But, you know, I can see it. Let's take the lines off the chart. So what do we got here? Low volume areas, low volume areas, low volume areas, low volume areas. And if you have a look at what price has done around those areas, we trade in this range, rejecting the low volume areas, accepting in the middle of the range. Okay, push up, accept around this volume distribution, and reject above and below it. Right? Then we move down, start accepting around this area. What do we do? Accept there, reject here, reject here. Right? So acceptance, rejection occurring on a smaller time frame there. So the same concept, right? Can you guys see that? Anybody not see that? Right, good stuff. So basically, you can apply it on any time frame. Now, some of us that are trading smaller accounts might want to look at more opportunities and smaller opportunities. For example, if you're trading the E-mini S&P, you might be looking for sort of 1 or 2 point rotations. You're just looking for the market to be trading in, say, a 2 point range, which 63 to 61 is enough for you to just take a few scalps for 0.2 points at a time. You could trade this range. Now, this range to me is no good. It's just too small unless I want to scalp. This is what I call scalper's heaven, but that's okay for their objectives. It's not that great for me trading it just within this context. But trading it within the context of what I've shown before, 69 being a key area above the longer time frame value, it's a good place to do some business. Okay, but nothing wrong with doing this. Trading around smaller time frame areas if you want to scalp. Right. So hopefully that makes sense. Good. So there's some examples. Here's a 5-minute chart. Again, you can have a look at this. How has this market been pushing higher here? You have a look, low to high here. You can see, volume distribution, acceptance, volume distribution, acceptance, volume distribution, acceptance. We had hardly no volume, then acceptance higher, acceptance higher, acceptance higher. Can you guys see how this market's just accepting higher, accepting higher, accepting higher for the moment? Okay, again, that's now the concept of imbalance. Acceptance continued to occur at higher prices. Of course, if it was a downtrend, you'll see it the other way around. There was a downtrend, so let's have a look at that. And you can see how the volume distributions continue to build downwards. So, we had the downwards push. Notice how we probably started with distribution up there somewhere. Then as we pushed lower, just make this all one color. You can see, okay, we pushed lower, rejected up here, accepted here, then accepted lower again, accepted lower again, accepted lower again, accepted lower again. Now that's the characteristics of an imbalance market, when we keep moving lower with price and keep accepting lower prices. When did it stop? When all of a sudden we saw price accept here and then here. Right? Can you guys see how we was accepting here and then all of a sudden we had some acceptance from that low higher, then more acceptance higher? So that changed. We was accepting lower and then all of a sudden we started to accept higher again. So look at the volume distributions to define acceptance, and always remember price is just the advertising mechanism. So price should be confirmed with volume distribution. If it's not confirmed with volume distribution, it probably won't stay up there for too long. It will come back to where it just come from. Does that make sense, everyone? If I'm moving too quickly for anyone, let me know. But we are going to start speeding things up because this is, we're going to start getting into some more advanced stuff as we keep moving on, especially tomorrow. But this concept of acceptance rejection also applies when it comes to order flow and trade location. Excellent, good. Okay, so that's basically how you want to apply the concept of acceptance rejection with the volume profiling tool. You want to understand value, balance markets and imbalance phases, and you also want to understand acceptance rejection as it can be read through the use of volume profiling. As I said, it can be applied in many different ways, and you can become creative with that to suit your style of trading and what you plan to do. You might plan to trade pullbacks and go with the trend. You might trade balance and around value like I do from a longer term perspective. Now, the reason we're going to cover divergence is because it's a good way to identify opportunities and identify when moves may occur before they do, because it's a heads up. Okay, good. So everybody pretty much understands divergence. I won't spend too long on it, but basically divergences can be found on many different indicators, and generally you're looking for a divergence between what price is doing and what an indicator is doing. Now, I use an indicator. Yeah, I use the delta. So I use cumulative delta as well as the volume breakdown indicator, looking at delta per bar. The delta is the net buying and selling. So I like to look for divergences between price and order flow, okay, which I'm going to cover. So divergences occur in a number of different ways. Now, classic divergences are probably the most important to focus on if you're looking to trade responsively and you're looking to fade the market around range bound phases and balance phases. So you will look for a period where the market, for example, makes a higher high like this, and an indicator, which in my case I'm going to be covering the volume breakdown indicator, looking at delta, makes a, say, lower high. Now, from an order flow perspective, if we're looking at the amount of aggressive selling hitting the bid and the amount of aggressive buying lifting the offer, this is quite a good indication that the market may be getting ready to turn, because if price is higher but more sellers are still hitting the bids, it means more of the aggressive order flow is actually trying to push this market lower. Then there's a good chance this market may be getting ready to reverse. So that's what we call a bearish classic divergence. Now, you can use other indicators to look at divergence, such as the stochastics, MACD, CCI. You name it. Any indicator can be used for divergence, which I'll cover in a little while on the charts as well. Now, a bullish classic divergence would be where the price makes a lower low, like that, and an indicator makes a higher low. So price is making lower lows, but the indicator's up here somewhere. So now that's a divergence there. Okay. Again, good for reversal. Now, we also have hidden divergences which occur, which are usually good for continuations of trending phases. So that will be, for example, the market making a higher low like this and higher highs, whilst the indicator actually starts to do the opposite. It starts to go this way around. So it starts to make lower lows and higher lows. Sorry, lower lows and lower highs. So that will be bullish. So if the market's in an uptrend on these pullbacks, if the indicator is the opposite, that's actually good for continuation of the trend. Hidden divergence is often called hidden divergence because they're a little bit more difficult to spot. I don't really use hidden divergences too much because I tend to be focusing on fading the market rather than trend trading. But they do occur in trending phases. And if I am looking to go with a market, which is a very rare situation in a trending phase, I do take that into consideration. In a bearish phase, price might be making lower highs, lower lows, as it does when it's trending lower, but the indicator may be going in the opposite direction. Okay, so that's what we call a divergence. It's basically when the indicator or oscillator is doing the opposite to price. So let's have a quick look at some charts. This is a 30-minute chart. I probably want to move this down to, say, a 5-minute chart. Now I'm going to add on two indicators. Let's add on a stochastic, which is quite popular. And I used to use the stochastics because I used to like the divergences on it. But you can use a CCI or anything. But as I started to use market delta and understand order flow a lot better, I started to use the volume breakdown indicator a little bit more so. Now I must add that divergences are optional, but they are a good heads up. Now I use them more on a micro level when it comes to order flow, which I will cover in more detail tomorrow. But this is one of the indicators that we like to use. You will actually have this in Investor RT and Market Delta, even though you may not have the footprints. So this is the where you can still read order flow in Investor RT if you're using that. So there's a couple of ways to use this. You can accumulate all values, which is what Peter's just referred to there as the cumulative delta, okay, which is accumulating all values, and that looks a bit like this. It pretty much looks like price-based candlesticks, but rather than looking at price, they're looking at order flow. So you can use that as well, but for the purpose of the examples today, I'm going to just look at the volume breakdown based upon the delta bar, okay, or the delta per bar. Okay, so we are looking at a 5-minute chart, so we're looking at the delta per 5-minute bar. Now, of course, if you change the time frame or the periodicity, it will reflect the delta for that particular bar. So if I'm looking at a 1-minute bar, it will show me the delta for each 1-minute bar. If I'm looking at a 500 tick bar, it's going to show me the delta for every bar that trades for 500 ticks, which is 500 trades. Right, so there's a couple of ways to display this. You can display it as delta bars, or which gives you the highs and lows, the little white wicks, or you can take the wicks off by just looking at delta. The delta, if anybody's not familiar with delta, is a net buying and selling for that particular bar, and it does build in real time. Now we will be looking at order flow at price tomorrow, but today we're just considering this for each bar for the purpose of divergences. Delta at each bar is only looking at what we would consider the aggressive trade, or what some of you will be more familiar with, knowing as market orders. So market orders are going to lift the offer, and market orders are going to hit the bid. Market orders will lift the offer when a person looks to go in that market and buy, and market orders will hit the bid if the market participants wants to go in and sell right now. So there's usually a sense of urgency with a market order, and that's why we call it aggressive behavior. Because there's a sense of urgency, we define that as aggressive behavior. Because people want to buy, they want to buy right now. They're not willing to wait to get hit on the bid, and they want to buy right now because they think the market's going to go up. Sellers that hit the bids are more aggressive trade because they want to get in right now. They don't want to wait to get filled on the offer, so they go in and hit the market on the bid and get short. So sellers hit the bid and buyers lift the offer. Now volume breakdown, the volume breakdown indicator will break down this volume based upon the amount of selling that's hitting the bid and the amount of buying that's lifting the offer. When buyers are lifting the offer, it's assumed as buy volume. Okay, it's considered buy volume. When volume hits a bid, it's considered as selling volume. That doesn't necessarily make it true, because you will find that the market may see the sellers hitting the bids and the market is actually pushing up. Okay, and you will see the market is lifting the offers, the market is moving down. I'm going to go into more detail on that tomorrow. I often get the question, how can the delta be positive but the market is moving down? How can the delta be negative and the market's moving up? And the answer is because it is. That's what it is. The market is moving down, even though more buyers are lifting the offer. The market generally on more liquid products like the E-mini S&P and the Euro stocks will move in the direction where the aggressive trade is occurring. If more buyers are lifting the offer, generally the market moves up. If more sellers are hitting the bid, the market moves down. But there will be situations where divergences occur. Price will keep moving up while sellers keep hitting the bids. Okay, that's what actually causes the divergence. Okay, so when the buyers keep lifting the offer, as the market keeps moving down, that causes price to keep moving lower, but the order flow keeps showing that there's more buyers lifting the offer. So that's where the divergence occurs, and that's what actually leads to a potential reversal for us. So that's exactly what we're looking for, that kind of divergence, that inefficiency occurring. So let's have a look at the delta bars. And let's see if we can spot any divergences here. And we had a divergence here. Look, delta spiked up right up here, made a high. Delta from that moment started to drop off. Okay, so that means less and less buyers are lifting the offer. But what happened with price? If you look at that exact same bar where that high was made, price was still down here. What happened since that high? Price went up. So straight away there we have a divergence with price, volume breakdown moving down, price moving up. Right, so that's a clear example that there is a classic bearish divergence. There is less and less buyers lifting the offer, but price is still moved higher. Now that's a good heads up that the market may drop. Now it took a bit of time, but the market did finally drop. Can you guys see that? So that's a divergence. Now we had also an example. This is the most recent example, so it makes sense for me to just do that. You'll find these examples every day, pretty much on every market. So I'm just using the most recent example. This was yesterday on the mini S&P. So you know, here I also consider this as a divergence as well, when price almost makes exactly the same low. Okay, in this case, so it's not quite a lower low, but if you look at the delta, it's clearly a higher low. So that's still a divergence as well. What happens? Price corrects itself, it moves up. So divergence is often a heads up. The reason why you see all of this low volume here on the volume breakdown is because that's ahead of the time where the pit session opens up and there's low volume there. But you know, you can go back, have a look at more and more examples. Here's another example where price made a double top and the volume breakdown started to drop off, and then price followed through and actually saw the reversal. So often it's more of a leading indicator. Divergence occurs before the movement actually happens, and that's why I love divergence, because it's a heads up, and I'm always looking for an opportunity before I get in, right? Which is actually the way that every trader should focus on approaching the market. Identify the opportunity first and then wait for the right time to get in. An opportunity, remember guys, is not a reason to get in. What we are covering right now is, okay, heads up, start looking for an entry. I'm not going to cover getting into the trade until tomorrow. Okay, this is only when you see something like this occurring. Now that might be at a key level, key low volume area. Let's just assume there's a low volume area there, and we got a delta divergence. Now we can say to ourselves, okay, as soon as I get my confirmation, got my reason to get in off the order flow, and I see reason to get in, I'm going to get in. Okay, but already, well, you know, you could sit here and say, okay, look, there's value here. There's some divergence. Let's just take a profile here. Take these lows up until, you know, we probably have to go back in time, but you know, you get the idea. There's a low volume area there, but you know, let's just say there's a low volume area up there. We're getting cut off. We've got some divergence. So now, not only do you understand that, okay, the market may potentially move down because of structure, but you now also got some evidence from an order flow based indicator saying, okay, less buyers are aggressively lifting the offer, but prices up here. So what does that mean? Well, price in most cases will have to correct, and it will drop off. Okay, it will move in the direction that the order flow is going. So if the buying is drying up and the sellers are starting to hit the bids more aggressively, and the price is still higher, price will generally start moving in the direction where the order flow is going. Okay, you know, we've got onto the other side of value here. You see price makes a lower low, and what happens with the order flow? It actually starts to edge up just before that, and then the order flow bases out, price makes a lower low, and what happens? Price pops up. So this is where the divergence can really help if you're trading responsively. Now if you're looking at trend trades, and we can sit here and go for examples all day long, but as long as you guys get the main concepts here, this is just identify the opportunity, the reason for actually looking to get into a trade. You know, we had a bit of a upwards trending phase here, right? So you know, we could get a composite profile, take that up from this low up to this high, and we can then look at the indicators and see, okay, Was there any hidden divergences? Was there points in time where price made a higher low, but the indicator made a lower low? And you will generally find those in quite strongly trending phases. You can actually see it on the stochastics a little bit more so here. So look at this little swing up, swing high. There's a high low. Look what happened on the indicator on this low right here, right there. So on that low, what happened? Okay, this stochastic made a lower low whilst the price made a higher low. So that's a hidden divergence. So price made a higher low, or started to make a higher low, whilst the indicator was making a lower low. That's often a sign of a continuation in a trending phase. You probably see something in the downtrend here as well. Hidden bearish divergence. So here's a price moving lower. So you're looking for a lower high, but a higher high in the indicator. Here we're making lower highs, and what happens on the stochastics there? Lower, higher high, sorry. So it's the opposite of what the price is doing. So that's the focus really is in a downtrend. If you're looking to sell the bounces and you're looking for hidden divergence, focus on what the highs are doing on both the indicator and price. Price making lower highs and the indicator starts to make high highs, you know there's a potential reversal for the continuation of the trend. Now, if we're in an uptrend, it's the opposite. If price is making higher lows and higher highs, all of a sudden the indicator starts making lower lows, then you know you can assume that the price may continue to move in the uptrend direction. Okay, so there's a number of ways to use it. Like I said, typically I will use regular divergences and trade responsively. So, you know, something like this up here is a key reason to get short, and most of you guys know I actually took that short, although I got flat, then later on I got short again. So, you know, the expectancy was coming to the lunch period, it might stay there for quite some time, but we still hold the key level. Okay, so I mean, it's basic stuff, divergence. Is there any questions about divergence? I just wanted to cover it because I do use it, and I will be covering it tomorrow as well when we get onto the order flow stuff on a more micro perspective. But again, it's more of a heads up. Again, you see it on any time frame. It doesn't necessarily have to be a volume breakdown indicator. It can be any indicator. Then I want you guys to use it in your own way. You know, here we saw, have a look at the stochastics here. You can put it in any setting you like, but you know, have a look at the stochastic. Price is making higher highs, higher lows here. What's happening with the stochastic? Lower highs, price sells off. Stochastic here, lower highs, price makes a higher high. What happens? Price sells off. Okay, again, higher highs in price, lower highs on the stochastics, price sells off. Okay, and that happens ahead of the actual move. Now, remember, you've got to use that as a heads up. Don't expect a divergence to play off there and then, especially on a longer time frame perspective. Divergences on a micro perspective, as I will cover in the order flow tomorrow, will play off quite quickly. Okay, and you will use that for execution. So you will use micro divergences for execution, and that's typically how I use it. But I will reference divergences from a longer time frame perspective as well, if I can see them. But as I said, they are optional. Right. So that's divergences. Any questions on divergences before I move on? Doesn't look like we will. Okay. So we're going to be covering Fibonacci next, and I'm going to be covering the unique way of using Fibonacci, the way that I use it, and not the way that I covered before with the 50%, 61.8 and 38.2% retracements. We don't need to use that. There is a way to use Fibonacci, and most of you guys are familiar with it, using the 127.2 and 161.8 Fibonacci extensions. It's very uncanny how accurate they are, and these levels hold again on any time frame. It's fractal and on any market. So we'll cover some of those, and that will help us identify some of those opportunities, the expensive premium opportunities and the discounted wholesale opportunities. So I'll be moving on to Fibonacci next. Let's have another 5-minute break, guys, and we'll get started again very shortly. Right, guys, okay, welcome back. So moving on to Fibonacci now, and using Fibonacci the L2ST way and how it fits into the use of around the auction market theory principles, which is quite unique to the way that I use it. The thing is, I've been using Fibonacci a long time, and I even before I understood auction market theory and volume profiling as well as I do now, I've always used Fibonacci, and I've used it in the same way that I do right now, using range extensions. And I'll show you how to do that if you are new to it. Some of you have already covered this before, I'm sure, but it's very, very effective, and it complements volume profile trading and auction market theory principles very, very well. It can be used for identifying opportunities when we get a breakout out of a range. It can also be used for profit taking when you're already in a trade. So there's two applications of this tool, but again, it's applying the tool with the understanding that you have just gained, okay, or may have already gained, but are beginning to improve your understanding of. So we're going to cover the VWAP next. So let's just move to the charts. So we saw a good example actually of this just recently. Let's just move up. Actually, we'll leave it on the 30-minute time frame. It's all good. So we've been looking at this area of value most of this and last month as well. So in the later part of February, we were trading around that range. Now, what often happens is that price itself will still break out of that range, and which some traders will assume is the new trend beginning. And sometimes it is. Okay, sometimes it is. Sometimes we get a breakout of a range and a trend does begin, and the imbalance occurs. But however, more often than not, what we'll find is that it's more of a test. It's more of a test outside of that range to see what is out there. So there's a number of reasons the market will do this. Firstly, if it doesn't find enough buyers, say in this situation down here, below value where it found them before, well, what do the auction market theory principles tell us? Price will continue to advertise lower until the opposite force is found. So in this situation, yes, the sellers were found above value, but they did continue to push through below value and outside of this range. So let's look at the highs and lows of this range. It's pretty much this, right? So we're pretty much range bound until this breakout happened here. So there was a breakout, and some people trade breakouts. Now, what I don't trade breakouts, and some of you might. There is nothing wrong with trading breakouts. I just don't personally trade them. Okay, I personally am the person on the opposite side of a breakout, looking for an opportunity to take advantage of the breakout occurring. Okay, so if there's a breakout towards the downside out of range, I'm normally looking to buy. If there's a breakout out of a range on the upside, I'm normally looking to sell, which may be the opposite to what many traders are looking to do. But understanding the auction market theory principles, it makes more sense. Okay, so if we're breaking lower here, advertising low prices, it makes more sense for me to look for discounted wholesale opportunities. If you take into consideration the framework from earlier, it looks, even when we get up here, it's going to make more sense for me to look for expensive premium prices to sell off, at. Okay, so how would we establish if we get a breakout outside of this range? How would we establish without the use of volume profiling? Now, volume profiling will complement this. Without the use of volume profiling, where might we find some sellers up here if we break this high? If we break this high of 1371 halves, where might we find sellers up there? Let's say we don't have any volume profiling information about this. Well, this is where the Fibonacci retracement tool comes in handy. Now, I've got a button defined for this, but you can use any Fibonacci retracement tool. Notice here that I'm not using the Fibonacci extension tool. You can use that, but I use the Fibonacci retracement tool. And the trick here is take the swing high to low of the range and the swing low to the high of the range. So if I'm looking at a potential breakout towards the upside and I'm interested in shorting this market above value as the breakout towards the upside occurs, what levels may I be interested in? Well, I would take the high, a major high, to the low of the range. Now, I often get a question which high to low to take. It doesn't actually matter. You can take all of them if you like, but normally I just pick the one that comes to my mind first. I look for the most significant high to low. So for me, the first one that comes to mind is this high to low. So what that will then give me is Fibonacci extensions on the other side. Now, you do have to set up the Fibonacci retracement tool to include these extensions. By default, your tool will more than likely not be set up to use the 127.2 extension and the 161.8. Okay, so normally it's set to use 38.2, 50%, and 61.8. However, we're not interested in those. We're interested in 127.2 and 161.8 extensions. So that's how you set up the tool. And what I do is I set this up as default. If anyone's not quite sure how to set up the tool, let me know. I can always help you out. But basically, once you set up your tool to the Fibonacci retracement tool to use the 127 to 161.8 extensions, you can then save it as a default, which is what I've done. I'll save it as a default FibR, and then I assign a button in Market Delta to be able to toggle that tool on and off. Okay, now one of the interesting things we saw was, now it's not always exact, but you'll be surprised at how exact these levels can be. Actually, this was an extension on the other side. Before we had this breakout here, if you notice here, we had a high, and then we had a test of this high, and then we had a breakout. Okay, we had this level when that happened, because I had this high to low. Okay, so we can see the 1272 extension there, and very close to that 161 extension there. I think I adjusted this at that point in time to this high to low here, and you can see what happened is we tested the 1272 extension on that side, traded in, then we got to the 161 extension and traded in. We got all the way to the other side of value, pushed back up again. Right? The trick is to use this in a balanced phase. So if you find that the market is balanced and it looks like we're going to get the breakout out of that balanced range. Now, when we had this push towards the downside, take this low to high, you can see what we tested. We tested right into that 1272 extension area, tested below it, then held, pushed all the way back up again. So it's not always exact. The smaller the time frame you apply it to, the more exact it is. Okay, the more accurate it usually is. Quite often holds to the tick. But if you apply it on a longer time frame, sometimes we push through. Now, I often get the question, as I said, is which low to take. Now, I've taken this low to high. It doesn't matter if I took this. It doesn't matter if I took this low to high, and actually that's the 1618 extension pretty much to the tick. Okay. Now you can take them both if you like, or you can just take one of them. The thing is, even if I have this low to high here, I can still see it's in that area. It's in that area. It's still into that area. Basically, what I'm usually looking for is somewhere in that zone. The range between the 1272 to the 1618 extension is a zone where that reversal may occur. So when I have those extensions, a lot of the time it's somewhere in that range. So I can highlight value here, and I can say to myself, this is expensive premium where I'm expecting sellers when we get up here. And before this market even got down here, I could say, okay, this is where I'm going to be focusing on buying. That's what I was saying actually when this market dropped down that day. I said I've got a 1272 extension here. I'm going to be focusing on buying off this because I see the bigger opportunity for the rotation back up. Whereas the shorter time frame players were saying, okay, downtrend, let's sell some bounces. Okay, so that's an example there of how you would apply the Fibonacci levels and what levels to use in the way that I use it. Now we can define some other ways to use this as well. Now let's say, again, let's just say I was short from up here and I still had some contracts running in this trade. What target would I go for after I've already covered some profits here? You could then use the 1272 as a target. Okay, the next target below that could be the 1618 extension. Let's say I am long here now and I've covered most of my position up into this high. What targets could I have upside? So this is where I said you can use it as targets and also for entries. You can say to yourself, okay, I'm going to look to target the 77s. Again, this all falls into the line, the framework that I've covered earlier. It all falls in line with that. I'm sure that you guys can see, if you understood the pricing model that I covered earlier, how this may fall into that. So if we look at this, can you guys see how expensive premium could be around the 1272 1618 extension? And heavily discount price could also be the 1272 1618 extension area. So if you understood the auction market theory principles from earlier and you use the tool in reference to that, you can see how it could come in very useful. Like I said, the psychology of it is covered earlier. We may have to test above this high to see what's up here, just purely to see if people want to buy up there. We might want to see if people are willing to sell up there. We might want to test below this low to see if more buyers are willing to do buy down here as well. We might also want to test to see if people are willing to sell down there. Okay, and this is usually when we get the stop run. Right. Hope this is making sense. Okay, so any questions about Fibonacci? I know most people are familiar with it, so it's quite a basic tool. But that's basically the way that I use it. I define the areas for doing business above and below value, and areas to take profits above and below value. Oh, there is one more use of it actually. In a trending phase, let's just say you are buying pullbacks. Let's say I am buying a pullback here. Now you could also take the swing high to low. Let's say you bought this pullback. You want some targets to aim for above the breakout of that prior high. The other application of it would be like so. So we grab the tool again. Let's just say we just got long right here. We plan to take some profits before the retest of this high, but then we need some levels to take some profits above this area. What could we aim for? Of course we could aim for the volume profile levels, but let's apply the Fibonacci to this, you could also target the 1272 extension. Now you can see here, when we broke out, what do we test? 1272 extension, rotate back down. 1272 extension, rotate back down. What do we test afterwards? 1618 extension, rotate back down. So good profit taking levels as well. Now, if I was to grab that tool and take it from this high to low, you could also take profits of those areas there. Now, any questions about Fibonacci? Any questions at all? Right, excellent, good stuff. Right, now, most of you guys are familiar with the VWAP, the volume weighted average price. There's a number of ways to use this tool as well. Again, it very much falls in line with the auction market theory principles and finding key areas for doing business as well as profit taking. The important thing to do with the VWAP is use its first and second standard deviations. Now, I know some of you have also started to use third standard deviations, which I personally don't use, but you can use. Typically, the VWAP, it helps you measure the developing unfair highs and lows. It's very much the same as using a market profile or volume profile to show you the value of high, value of low. Typically, we use it on an intraday basis. So it starts at the beginning of the day. You have the volume weighted average price from the beginning of the day, and it continues to extend as each bar trades. And you get the first and second standard deviations of the VWAP, the volume weighted average price, which continue to plot as the day goes by. Now, you can also apply the VWAP on a wider time frame. You can have weekly VWAPs. You can have a VWAP for the last 2 days, 3 days, etc. So in a very similar way, as you would to use a volume profile from a custom time frame for a custom time frame, starting at a specific date and then finishing at a specific time. So you can do the same with the VWAP. Now, I typically use the VWAP from an intraday basis. I use it more for shorter time frame analysis. I use the volume profile and market profile stuff for longer time frame analysis. The VWAP is a good proxy for me to establish where the price is in reference to the developing areas which market participants may see as unfair and fair. So basically, the VWAP, the volume weighted average price, is seen as the recommended retail price or the first price, very similar to the volume point of control. A lot of the time, it matches with the developing volume point of control, and the developing value of highs and lows will often match up on the volume profile for the day with the VWAP first standard deviations. So this is typically how I would perceive price around the volume weighted average levels that I've just discussed. Dave, for day trading, do I start it from the beginning of the Globex session? Absolutely, yeah. So for day trading, now I see the market now I perceive the markets from the time that they start trading in the Globex session right up until they close. So I know some traders will only look at the pit session, which is fine, but I find that, for example, the US indexes, the Dow, the YM, the Russell, the E-mini S&P, give you a lot of important information from the Asian and European session. So I like to have a VWAP building from the overnight session going into the regular trading hours, the pit session hours. Now, on European markets, I will have them trading right from the open right until the close. So generally, you want to have the whole auction plotted with a VWAP, even the overnight action. You may want to have 2 charts. You may want to have just the VWAP plotted for just the pit session and change that chart to just display the bars for the pit session. But I prefer to look at all of them, okay, personally, and I recommend that's how most traders should use it, okay. So the VWAP, see the VWAP as the fair price, the recommended retail price. So if we looked at the pricing models earlier on, we see price as the advertising mechanism. When you can see the price advertising alongside the VWAP, now the VWAP is great. I love the VWAP because it's dynamic. It's constantly shifting and moving with the market. Now the value at high and value at low and the point of control is also moving on an intraday basis, and it's shifting. But I found through my experience that using the VWAP, it's nice and smooth, and it does give you some great opportunities trading around the VWAP areas. So I like to use a combination of developing value and the VWAP areas. Generally, I perceive the range between the first standard deviation high, which is this area here, and the first standard deviation low, which is here, as being an area of value. And typically, it will line up with the value area high, value area low of the volume profile. Now, we do have second standard deviations above and below this, which are important, and a lot of the time they will match up with the fib extensions that are covered, the 1270, 1618 extensions. Of course, you don't have to use all of these tools, and you don't have to use just one of them. Okay, just understand how they work and how they fit into the model of auction market theory, and understand how you can view price plotted alongside these overlays and tools, and perceive what may be too high and what may be too low, or what market participants may be seeing as too high or too low, above and below value. So the VWAP is the red line that usually falls in the middle. Now you can change it to whatever color you like. First standard deviation high and low above it, and then we have the second standard deviations above and below as well. Earlier on I covered recommended retail price, premium prices, expensive premium prices, wholesale prices, or extended wholesale prices. Generally around this area, if the market is balanced, especially if we see most of the volume distributed in the middle of the range, we would expect sellers here, buyers here, buyers here. So that's the expected responses, and typically that's what you'll find on most days. So you will have a look at a daily chart and you can see, or an intraday chart, and you can see that the price is often trading within and around the VWAP areas. Now sometimes the market becomes imbalanced and prices start to move away from the VWAP bands just as it starts to move away from value, and this is when you'll see the VWAP bands started actually trend themselves. They will start to push lower, very much like moving averages do, and prices start to move away from them as well. So prices start making lower lows, lower highs. If price is developing lower and advertising lower, we would see this as prices advertising lower and leading value. So price starts to build lower, but remember, if you use the VWAP with the volume profile tool, we could then also confirm this as trying to move away from developing value with volume profile, the volume profile showing us that volume is building down here. Okay, but the VWAP bands will be nice to confirm what is happening and also see from a different perspective that price may be trying to move away from where it previously found value. We also see it in an uptrend, and it looks a bit like this. Again, textbook examples, but it's not far off exactly what happens. We'll see price will come from the unfit low, push up, hit the unfit high. Then, let's just say we don't find enough sellers up there to take all the make the full rotation down, okay, down to below value. Well, we could see buyers somewhere here, and then all of a sudden we start moving away from value, and then again we can confirm this with volume distributions. So this is just price in reference to the VWAP, but we can confirm it with the volume distributions and acceptance that occurs. Right. Let's move to some charts and show you how that works. Right click on the chart, add the VWAP, volume weighted average price. Looks a little bit like this. Let's just stick with, say, 5-minute chart will probably do. So, you know, here we can see price trading around the VWAP bands. What do we see? Typically, market gets below the VWAP bands, advertisers gets back above it, advertised gets back into the VWAP bands, back below it, and you can see it how it's testing the second standard deviations, which are the yellow lines, either side as well, and then staying rotational and sideways. Now, when the market starts to trend a little bit and pushes away from the VWAP bands, like we saw yesterday, see the price pushes away, starts to move away from the VWAP bands, pushes back in, not too far off what we've just shown on the textbook example there on the slides. Put it back to the VWAP, then push away, and then you can see it starts to move away from value, and then we start to trade away from the VWAP bands. Then at some point, yes, the market does come back into the VWAP bands, not always in the same day, but you know, that's how you want to use it. You know, don't overcomplicate it. You're just asking yourself, is the market trading around my VWAP bands, and therefore, you know, I can assume the market is balanced. If it's moving away from my VWAP bands, then I can assume it's trying to become imbalanced. That's what you're trying to establish at the end of the day. You're trying to establish how to trade the market based on the context. If it's a balanced sideways market, it looks like it's trading sideways and it keeps finding sellers above value and buyers below value, you keep trading it that way, okay, until it starts to prove that it wants to move away from that area. You know, we have a look moving back. Here was the day when we had that downtrend, and you can see how the developing VWAP pretty much got left behind. We started to trade it in the earlier part of the day. We started to pull away from it. Couldn't really trade around that area, just kept pulling away from it. Okay, so typically in a downtrending market, we spend most of our time below the first standard deviation low. And in an uptrending market, we spend most of our time above the first standard deviation high. In a balanced market, we generally will spend very little time above and below those ranges and get back into that range and continue to trade sideways. And most of the time, that's what you will see. You will see this. However, when the volatility increases, as we have seen in August, September, and at times when we've had some of the more volatile days, even this year, well, at any time where the volatility really increases on an intraday basis, you will see the price will start to move away from those VWAP bands. And that's when you either have to adapt or you have to move to the bigger picture and ask yourself, where are we? Where are we within the longer time frame perspective? Now, if you just trade short term and you just trade the intraday perspective, this is a good, easy way to start trading imbalance and balance. Actually, you guys that have been on the previous seminars before, a lot of the focus was on day trading around the VWAP bands, and that's pretty much still what you do. But you have to understand that the markets have shown, especially during the more volatile phases, that they do like to start pulling away from the VWAP bands. However, from a longer term perspective, we still remain balanced. Okay, so it's important to recognize that. It's important to recognize that intraday we may be seeing more what looks like trending phases and imbalanced phases on an intraday perspective. But actually, from a longer term perspective, we are still balanced. Even in August, we saw that. September, we saw that. Okay, we were still balancing, but we were just having wider ranges of balance, wider ranges of acceptance. And that's typically what happens when we see an increased amount of volatility in the markets. Right, so that's the VWAP bands in its most simplest form. Again, these are ways to apply the simple concepts of auction market theory. This is not a system. It's not every time we get above the VWAP first standard deviation high, we sell. Every time we get below the VWAP first standard deviation low, we sell. Every time we get above value, we sell. Every time we get below value, we buy. Now, if you want to make it systematic, that's what you would do. Okay, but it wouldn't give you that much of an edge. You won't gain that much of an edge. It's, yes, some of those trades will play off, but in the moment, you know, that itself is not going to be enough to get the most out of this method. You know, this is why the stuff that I'm going to teach tomorrow really takes this to the next level: trade execution, trade management. So, you know, you have to understand that these are purely ways to identify opportunities. I don't want anybody to think that you trade this in a systematic way. You will highlight these areas for doing business. So now, how do we put it all together? Let's have a look at some of my charts on an intraday basis. What I want you guys to understand is how you put it all together and understand and recognize areas for doing business. Okay, but then you still have to decide whether to take the trade or not. So these are high probability opportunities. But yet, as discretionary traders, you have to find out more information about that opportunity to decide whether to take it or not. And that's really when you start to get the edge. Okay, just looking for a chart here. So, you know, this is typically what my chart looks like, you know, in the trading room. That's a tick down there. We've got a volume breakdown indicator at the bottom. We've got the VWAP bands, and we've got a volume profile on the right, and we've got a developing profile for the day. Now, you don't have to use all of this, but this is how I use it. We've got the volume profiling information for key levels. I've got the developing profile for value for the day, and it also shows me where value was the previous day. I've got the developing VWAP bands, which shows me from a VWAP perspective where I could perceive value to be. So I mean, this is the trades that I'll take on Friday. Got short, 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 and then short again. And you know, I'm basically just trading responsibly off my area. So you know, we've got a low volume area. If you're gonna have a look here, this is a low volume area that I was shorting off earlier. Then this is where we've got into this area, nothing set up, no short. That's where the order flow keeps me out of that one. And then we've got shorts at these areas. I actually got short here, got flat, and then got short again later part of the day and caught some of this move. Right, so you know, we can go back. I mean, here we have the VWAP first standard deviation low tested. Look to the right, low volume area. So this is where you can say, okay, VWAP band, developing value area low. So I've got my value area. I'm looking for buyers down here. Pick my levels. If I can look for some buyers at 52s, I'll buy there. If I can find some buyers at 50.75s, I'll buy there. In this situation, there were some opportunities to buy right there. So that's how you would use it. You get back to above value, you might consider taking this short. Again, if it sets up with order flow and price confirmation that I'll teach tomorrow. And you might take this one. Well, actually, it's okay. Well, first of all, don't be systematic. Like I said, don't be systematic with this. Okay. Now you might be thinking, okay, I shorted within value because there's the first standard deviation high is above us. Doesn't matter, because this opportunity may have already started. Okay. Firstly, I'm looking at this. Okay, it started up here. I wasn't there trading that. If I was, then I would have taken that one. Now, a lot of this actually happened on the number. So this move actually happened within a few seconds. If you have a look, 130, the time was there, went bang, bang, bang. And it was up here again. And actually, when the market opened up, this is my next place to get short. So I would have preferred to got short here. But this is going to move on to tomorrow's stuff, where if you missed an opportunity, where do you get in? So although I'd love to get short higher, if you're not trading at that point in time and the market hasn't opened up, remember the cash market opened up here after this. The cash market opened up here. So I don't have the opportunity to trade this or this, but I can recognize it happened before I started to trade. So if the opportunity was there to trade it, the rest of the move may still continue. That's where you've got to see that. Okay, but you know what I want you to understand is the VWAP bands here maybe skewed a little bit because of all this choppy action we had. So, you know, don't make it too systematic. It doesn't have to be, okay, we have to be above that value area, because I might be perceiving the value area, and I was perceiving a value area from a longer time perspective. I'm not trading the intraday value area here. Okay, I, at that point in time, am trading this. If you was in the trading room, you would know I was trading this area of value from a longer time frame chart. So it depends on what perspective you look at it. If you're looking at it from an intraday perspective, it might appear as if there's been a short within value. But if you're looking at it as, okay, from my perspective, I'm looking at, this is my area of value, this is my perceived area of value, I'm shorting that unfair high, knowing that it also comes from the developing value area high on the intraday perspective, but I'm trading this range. I was trading for a target of 58. So I didn't short within my perceived area of value. Does that make sense? I'm shorting above my perceived area of value. So perception is important. My perceived area of value is what I am trading around. It may not necessarily be the developing intraday value area. Okay, that is great if it lines up with it, and it did earlier on in the day. It lined up here, but that move was impossible to trade because it was off the number. You know, it's set up here and it continued. So I'm going to take the trade that comes next. Now, later on in the day, it's above value. So, you know, this is just an example, okay? But yeah, I mean, it's nice to have the shorter time frame confluence, which is the intraday perspective, but it doesn't have to be there. I am trading the longer time frame chart. If the shorter time frame confluence is there from an intraday perspective, it's good. But I will be willing to sell down here below developing value if it's above a key value area that I am actually trading around from a longer time frame perspective. What you have to understand here is that you all have to have your time frame for doing business around. And each and every single one of us may have a different time frame to do business around. So if your objective is, say, 1 point or 2 points on the mini S&P, you might just take this, okay, from an intraday perspective. However, if my opportunity is to play off this rejection up here and to look for the push in the 58s, I'm looking at potentially, you know, a push from what, 63s down to 58s here. I'm looking at a bigger potential move. So it's important to understand that the trades that you will actually look for have to suit your objectives, which is actually the next topic I'm going to be talking about, identifying risk to reward. Okay, so you do have to apply the concepts in reference to your plan to reach your objectives. A trader that is looking for 100 ticks may be looking for a completely different trade than somebody that's looking for 10 ticks. Right? Doesn't make either of them wrong in what they are doing. But you can trade the same method, the same style, and the same level of understanding, but look for a different objective and take a different trade. Okay? So, you know, here's the Nasdaq here. There's some, you know, a good day here. We were just trading around the developing VWAP and the developing value area. You know, that's nice to see as well. Got some levels here as well. Testing this low volume area right here. Holding, push up, holding again, push up. Holding these low volume areas above value, push back down. Just giving you some ideas here, guys. Okay, this is all ideas. Remember, when it comes to identifying opportunity, all it is an idea. Okay, but it's a high probability idea based upon your level of understanding of market structure and what you expect to happen. Now, what we typically find is that with the increased volatility that we often see these days, is the market cannot trade around the VWAP bands as maybe as closely as we used to find 2009, 2010. And in the previous seminars, I covered a lot around the VWAP bands, and that's pretty much how most trades traded, around the VWAP bands. And but we since the increased volatility, especially in August, had to start adapting and understanding that the market has a tendency to trend intraday but still stay balanced from a longer time frame perspective. So you have to understand the market conditions do change, but the concepts still remain the same. Okay. We're going to now move on to step 3, which is identifying risk and reward. Any questions about VWAP? I don't expect anybody to get it completely, but you only really need to get the basics, the basic concepts, and then apply it creatively. As I said, there is no specifics here. The VWAP is what it is. It helps you see what you need to see. The volume profile is what it is. It helps you see what you need to see. What you've got to understand is, the basic foundation to this all is that you're trying to read market behavior. You're trying to establish when the market is balanced and imbalanced. You're trying to establish where the market may find turning points, such as low volume areas. And then you're trying to establish where the market may go to, which is those acceptance areas. The VWAP bands, Fibonacci and divergence that I've covered are tools that can help you trade around those ideas. Does everybody see that? So I wouldn't want anybody to think that you trade every single divergence, you trade every single advertisement or price above the VWAP bands. It doesn't work like that. It all has to be put into context, which is step 1 of the game plan. Where are you coming from the top down approach? What is the bigger picture here? What's happening on the daily chart? What's happening on the longer time frame chart? Now, within that context, what's happening intraday? What you don't want to do is go into the market and say, okay, I'm just going to trade around my VWAP bands and I want to just trade what I see intraday today. That's okay if you're a scalper and you're trading short term. That's absolutely fine, okay? But I would still expect, as a minimum, you guys as traders to go from the top down approach. I think it will help you out even if you are looking for the smaller trades, the shorter term trades. You should be able to say to yourself, okay, this is what's happening on the daily chart, even if it's just to understand what is going on from the bigger picture. The reason you need to understand what's going on in the bigger picture is if you're trading too short term, you might end up trading into those bigger time frame players. And you need to understand where they might be. And we're coming back to the concept of understanding the market participants again. So you need to understand where they are. Even if you're not going to trade off the longer time frame chart and look for the bigger move, you need to understand if you may be looking to, say, buy a pullback into what appears to be an uptrend, but it might be into some key unfair highs where the longer time frame sellers were expected. That's probably a good time to leave it alone. So context is important because the setups are pretty basic. The setups are not that complicated, but taking the right setups and trading the right opportunities at the right time comes down to what? How do you know when to take which trade? How do you know when to fade above value and fade below value? How do you know when not to fade above and below value? What does it come down to? It's nothing to do with the tools. The tools are just to help you out. They are decision support tools. What does it come down to? How do you know when to trade around a balanced structure and when to trade with the imbalance? How do you know? Does anybody know? How would you understand, based on what you know right now, how would you look at the market and say to yourself, okay, I'm going to be looking to fade the market, I'm going to be looking to sell above value, I'm going to be looking to buy below value? How would you know? Anyone? Well, you could ask yourself a simple question, right? Yep, you can look for rejection acceptance levels, but key fundamental question that people have to ask themselves is the market balanced or is it imbalanced? If it's balanced, and it looks like it's trading sideways, the most important thing to do is, continue to look for those opportunities where you can fade the market above and below value. Look for those opportunities. Use the VWAP in that context. Understand the market sideways, and you should be looking to sell above the VWAP first standing deviation highs and lows, or the value area highs and lows at those key low volume areas. If the market is in balance, you might be going with the market. You might be looking to buy above the VWAP first standing deviation high and sell below the VWAP first standing deviation low. But the market is also showing you volume distribution in that direction. And then you're looking for low volume areas, okay, to buy pullbacks, okay, to sell the bounces. So you put it all into perspective. So basically, how do you know? You put everything that you've just been listening to into perspective. Right? Okay. Now, like I said, this is just identifying the opportunity stage. It's step 2. It's okay, I've understood what's going on, the market's balanced, I'm going to be looking to fade above value, buy below value. Like I said, most of the time the markets are balanced, so I will come into every day looking for value, looking for balance, and saying, okay, where is value, where is balance? Let me find the areas to do business above it, let me find the areas to do business below it. That's it. Okay, it's that simple. But if the market is clearly not balanced and we don't have an area of value where we can clearly see market participants being accepting around, then I don't do anything. The only option I have is to go with the trend that may be evident. So that's my trading plan, that's my business plan, that's my way of doing business. So if anything, everybody right now should have been able to understand how they can establish a way of at least approaching the market and come into it and say, okay, I at least now know from what I can see what I should be focusing on doing, which is identifying the opportunity. Now, once you've identified the opportunity, you then have to move to the next step, which is step 3 of the L2SD game plan. You need to understand whether that opportunity fits your risk to reward parameters that you are looking for. Right? So, some guidelines when it comes to risk to reward. Always know your risk at all times. Use a percentage risk management model, which I'm going to cover. Define your maximum risk per trade and per day. Have clearly defined objectives for a trade and also for each day. Visualize your risk to reward potential. Bit of a typo there, sorry about that, guys. Before entering every trade, and understand multiple scenarios. Again, another typo. Wow. Know what you would do if the trade is working as well as not working. This is a key point, really. You have to understand what you do want to see and what you don't want to see before you get into the trade. I often talk about the trades that I'm going to be looking to take in the trading room before I take them. I will do the pre-market analysis. I would say, look, I'm looking at this because of this. This is the reason why I'm going to be looking short here. This is the reason why I'm going to be interested in buying here because of this. This is where I expect the market to go from and to. If it looks like that's in any way starting to set up, I'm going to be going for that opportunity. Because I've already established, first of all, it's a great opportunity because of what I understand. Secondly, I've understood the risk to reward potential in that trade. I understand where that trade may go from and to. You should never ever take a trade if you don't already understand where the market may go from and to. And this is what it all comes down to when it comes to identifying the risk to reward before you take the trade. Of course, you do identify risk and reward in your business plan, in your trading plan. That's in the planning phases. But when it comes to actually planning to take a specific trade intraday, or even just before the day starts, you need to identify the potential risk in that opportunity and the potential reward before you enter that trade. And this is not just setting a set stop and a set target. Based upon market structure and the logic and the understanding that you just gained, what makes sense for you to risk in this scenario and for you to look for as a potential gain in this scenario. Now, you can only establish that if you understood the basics. If you understood how to read the market and understand where the market may go from and to. Based upon the auction market 3 principles, understanding value, understanding balance phases, and understanding acceptance and rejection. right? This is why you can't move to step 3 and really visualize this until you've understood that fully. So sorry about the typos there, potential and multiple, that should read, but you guys get the idea. Right, it's an example of how before you get into a trade you may visualize a potential opportunity before something happens. Now I do this all the time in the trading room, and I'll show you some examples of my pre-market analysis scenarios. I used to post them up online on Chartly, which I stopped doing now, and also on our blog, but you know, in the trading room I share my visions, my expectancies, and most of the time the market will do what we expected to do. Okay, sometimes almost exactly the way we expected it to have happened. It goes from the area where we expected the sellers to be to the area where we might find the next set of buyers. It's the only reason I'm able to do that in the trading room, and you guys see that, is because I understand the basic principles really well. I understand where the rejection might occur, and I understand where that move may potentially go to if it starts to happen, and I also understand where the opposite force may be found. Again, it's just simple concepts applied in a creative way, but understanding them really well. So, you know, this is a good example here. Let's just say, you know, you're looking to buy here at the unfair lows. You've got to understand, if the market doesn't go from here up to here, that it might want to put back a little bit lower and go from here to here. And this is where the scaling in and the stuff that I cover in the trade management section will really help. But when you see this opportunity, let's pretend none of this has happened up here. When you see this opportunity, you see this price advertisement here. Straight away, you should think to yourself, because we are below value, we have a good chance of going at least back to the point of control and to the other side of value. So just from looking at that, you can say, I have the potential of going from 45, 35 area to, say, 100. Okay, the question to ask here is, can I absorb the risk at the next logical price, which is 35? So let's say if you buy 45s, can you absorb that risk to 35? So you establish a risk area. This is your risk area. This is the area where you might be at risk. So you might get long here, but it may not necessarily move from there. But you've got to be okay with taking that risk up to the next level. Okay, so this is your premise and the reason for being in the trade. So a lot of the time I'd say, okay, I've got this area, this is my risk area, this is where I want to work in a long and start getting long, and I'm going to get in, and as long as it doesn't start trading and accepting below that, I'm going to stay with it. And that has nothing to do with you know, me putting a set stop in here or anything like that. My stop in most situations is way below this area, and I take a manual exit before we get in this area. Now I'll cover this in trade management tomorrow, but you know, you might want to use stops yourself, but you need to establish firstly what your risk reward is. You can't put a stop in unless you don't know what your risk area is. You can't start looking for profit targets if you don't know what your potential reward is in the trade. So this is where you visualize R to R, risk to reward. So you can say to yourself, okay, I'm going to go for this opportunity. The market may still want to push a little bit lower down to say 35s here. I'll be willing to take that risk, buy here, and I might even buy some more here. My risk area is this. My reward area is this yellow area. It may not necessarily get all the way up to here, but if you're trading the auction market theory principles, we know there's a very good chance the market going from the low of the range and below value to the higher of the range and above value. Very good chance. That's why it happens so often. And you know, you might be on the other side looking for a short here. There's a very good chance that we'll go to the other side of value. So just from trading around value, that's why I love value, because it's an efficient structure. If I buy below value, I already know that I can target at least the point of control and the fair price. And if I'm going to go for more than that, I can target the other side of value. So that's why it really helps to trade around value and trade around balance. Firstly, it's efficiency. I love efficiency. The market loves efficiency. So it makes sense for us to love it. Okay, so trade around efficient structure. Go for those wholesale opportunities below value. Go for those premium opportunities above value. But at the same time, understand what your risk is getting into that opportunity, and understand what your potential reward is by getting into that opportunity. Before you get into that opportunity, visualize it. You can sit there and use your tools and say, okay, VWAP first standing deviation low is here, I bought here, you know, my VWAP is there, I'm going to target that. My VPOC is there, my volume point of control, I'm going to target that as a target. I'm going to cover some there. You might buy 2 contracts in this situation. You might buy one here, buy second one here. You've now got your full position on. You'd cover one here, then cover 2 here. Good example of how to see yourself managing that trade before you even get into the trade. You have to get into the habit of knowing how you're going to manage a trade before you even get into it. Of course, you can make little adjustments here and there once the trade is open, which I do all the time, but you know, you've got to have a good idea of how you are firstly going to get into that trade, and secondly, what you're going to do once you're in it. Then you need to know what you don't want to see once you're in the trade, just in case you have to exit and it doesn't start to do what you anticipate, which will of course happen at times. And then you also need to know when it starts to work in your favor, what are you going to do? Where are you going to be taking profits? And you need to know that ahead of time. So, you know, just another example here. What you got to think of this is as a technical risk management model. So based upon the technical structure here of the market, this is a risk management model. If you're buying down here, you've got to be willing to take some risk in this area. If you're selling up here, you've got to be taking some risk in this area. It will become a little bit more clearer with some real examples, but you get the idea. Now, there's a couple of ways to approach this. You can say to yourself, okay, I'm going to buy here, but if it doesn't work here, let's just put that in a different color. I'm going to buy here. If it doesn't work there, I'm going to put a stop here. I'm going to get out, but I'm going to also consider buying here for this push up because the potential reward looks good. My risk is very small, and I'm going to accept a stop out here if that occurs. Okay. Now, there are other ways to manage this, which I'll cover tomorrow, but you know, the other way is, as I said before, you could buy one here, buy another one here, and then scale in. Right. So, but visualize it before it happens. I mean, we could go to some examples here. I'll show you some of the examples that I posted up in the trading room. Actually, there's some good examples here on the that I posted up on the blog. Because it was my trades from last week. So if you go to the blog, this is some good examples here of how I traded around my vision. So there was a vision for the day. I said, okay, this is basically the market hasn't done anything since this point. This is where we was trading at 72s. So I'm saying to myself, okay, it's either going to pop up here and push up through those levels. Okay, but most importantly, we have value here. I'm going to be looking for this push up in the 74s. I'm going to be looking at short 74s. If it pushes through 74s, I'm going to be looking at short 76s. Okay. Now, the other thing that I also took into consideration here was that this market may have already held the 74s and the 76s, which it did here, ahead of the market's open, and may only give us a bounce into this LVN and may push down from here. And then I expected this to go to 65s, and this is ahead of the market even opening, just from basically understanding, okay, this is value, this is my LVN above value. From above value, it should go down to the value low and test the areas where buyers are probably going to be interested on the other side. Logical stuff, very much common sense, but it gives me a framework for doing business around. What happened? The market did this. It's probably good to bring both up. So there was a vision, and a vision is basically envisioning it in your mind's eye before it happens, and that's what I mean by visualizing your risk reward. So I can sit here and say, before the market even opens up, and most of you guys are in the room know that I did this, and I posted this up before the market opened, and then I traded around this potentially happening. What happened? I anticipated the market may push to 74s, and I'm going to get short there. What happened? The market pushed to 74s, and I shorted at 74s. I then started to cover on the way down. What happened next? The market bounced up to 74, 75 area, which is pretty much this move. Bounced up into this area, and then continued down as well. Where was the target? The target was 65, 64 area. That was pretty much where I envisioned. 65, 64 area. Okay? I then anticipated if we got down there, the market may potentially push back to 73s. What happened? The market moved from 64s to 73s or 72s the next, in the later part of the day. The key thing here to remember is this was established before any of what you see on the right hand side even happened. And the only way you stand a chance of being able to do that is if you understand the auction market theory principles and everything that I've just been teaching you today. But you have to become creative with it. You have to understand it fully, and you have to understand it very well, and you have to know how to apply it. And this happens all of the time. This is just one example. Okay? Now, why do I take into consideration a scenario which I probably won't trade, which is this push up? Because I need to know if that's going to happen. I don't want to be getting short. So I need to know what I don't want to see happen as well as what I do want to see happen before I even get into the trade. So if anybody doesn't already do this, I'm sure some of you do, but some of you may not. You need to be doing that. Before you get into a trade, highlight your visions, highlight your expectancies before the market even opens up. Understand where you're going to trade and where you're going to expect that trade to go from and to. Why the reason I love value and trading around value is because it makes it easy to establish that, and it makes a very high probability. Because when we do find sellers above value and buyers below value, nothing's going to happen 100% of the time. But when we have an area of value like this, and the market's moving sideways, there's a very good chance the low volume area will find enough rejection to push all the way to the other side again. And we see it get on the other side here as well, push back up again. So that's what we trade around. Does that make sense, guys? That's just an example, but there's many examples. We could sit here and go through lots of examples throughout the day. I could sit here and go through another one here. There's maybe something that doesn't play off as well, but still does. Oh, here was the last one last week. I think it was Friday, not this Friday gone, but the Friday before. So we had the traditional market profiles, volume profiles, which I just put this up. But we had a longer time frame, unfair high at 73s. Said, look, if we can continue to see this rejection up here, because not a lot of volume is trading up here. If we come into 73s, I'm going to short that area and look for the push down back towards 59s. Now that didn't actually happen that day, all the way to 59s, but it did happen the next day. It happened overnight. So sometimes these expectancies from a longer time frame chart perspective may not necessarily happen in that day. They may happen the next day, or may happen overnight. But most of the time, you'll find that you'll be able to trade around that opportunity intraday and at least get a good trade off it. So it doesn't always go from exactly where you expect it to go from and to the final target. But even if I can get my first, second target in that trade, I'll take it. So that was one of the expectancies, 73 to 59s. Now that one played off a little bit differently. And as you can see, I actually ended up taking a couple of other trades as well. I took a short initially, but I covered at break even. There was around the VWAP, I was a little bit unsure. I just started to consolidate. Then I got long at a shorter term level here. And it doesn't always work out perfectly. And this is why I'm showing you this, because it doesn't always work out like that. Then I got long here, and then I got long at covered some at 71.5, then I bowed out at 70s. So I actually took a little bit of a loss there. Then it got to 72 halves, which is very close to the 73 level. Then I felt more confident. I got short, and then I covered at 71 half, covered at 70, 75, covered at 69 quarter, and then covered at 66 half. Didn't get to 59s, but actually that's where the market ended up closing at the end of the day. Then we pushed up, and then we pushed all the way down to 59s. But another example where it plays off, but not quite exactly the way that I expected it to, but I still traded around my plan. And as you can see here, I had a shorter term value area right here, and that's why I went for the long, because I had an LVN there. Now that long actually came off, and I probably bowed out a little bit too early. But you don't have to be perfect. You don't have to be perfect. Sometimes you get in and out of trades, and you might have wanted to stay with it. It would have been a good idea to stay with it. Most of the time, I make good decisions. The reason I get out for a trade is valid, and I'm not concerned about one trade or one day in particular, because each and every single one of us will never be completely 100% perfect in our trading. So it's good to understand that and know that. Okay, so that's some examples there. Visualizing risk reward and then actually playing around that. But again, understanding what I've taught you in the earlier parts of today. Right, we're going to talk about further risk management with the account. Now, some simple, basic recommendations here. I'm not sure where each and every single one of you are and what level you are at in your trading, but the basic principles for risk management doesn't only apply to per trade, but also for your account. So I'll talk a little bit about that. I don't want to spend too much time on this because this is covered in the business planning webinars and getting started webinars for most of you guys have as trading with members. If you don't have that webinar, I'll be happy to send that to you. The Getting Started webinar. So if anybody doesn't have the Getting Started webinar that's available to our trading with members, please drop me an email. It covers some of the concepts that I'm going to cover in some detail today and tomorrow, but in a little bit more detail. So it will complement this seminar and webinar. It's about a 3-4 hour presentation, which most of our room members have, or all of our room members have access to. Right. But basically, the key idea here is, firstly, depends on where you are. If you've been trading for quite some time and you have a lot of capital, you might be willing to risk more. But not everybody is in the same boat. Okay, not everybody here is trading for a prop firm and trading their capital. Some of us are retail traders trading our own accounts. Some of you guys here are trading for institutions, trading hedge funds. Okay, some of you guys are trading for banks. So everybody is from a different walk of life, and of course how you manage your risk is very different. Now if you trade for a bank or a hedge fund, I'm sure you have a risk management team that will look after most of that for you. Now if you are a prop trader and you trade the firm's capital, then they will assign a certain amount of capital per day to you. So they will do your risk management for you. You will have a risk desk that looks after your risk. Now I personally do trade through a prop firm and clear through them, but because I trade my own capital, it's a little bit of a unique setup, because I do have the ability to trade my own capital and I don't trade their capital, which I used to. Okay, so now I can set my own risk parameters. I can say, okay, I want to risk this much, so I have to still have risk parameters set. I still have to have a daily risk limit, and the risk desk will still cut me off for the day, but that's because I've set my risk limit at that. Now you guys that are retail traders trading your own accounts through retail brokerages, you should also have a risk limit for the day. I'm surprised at how many traders don't actually have this in place, and it will save them a lot of hassle and a lot of pain, or could have saved them a lot of pain as well if they'd done this in the first place. There is no reason why anybody should ever blow out an account. There is no reason why anybody should ever lose more than a certain amount per day, and it takes one simple thing to save yourself the issues with dealing with large losses for the day. The amount of times I've had traders come to me and say, I'll do pretty well and then I have one down day and I'll just give it all away. I'll be up for 2 weeks and then I have one bad day and I'll just give it all back. Well, if you have this in place, which is a risk limit for the day, it won't happen. You physically cannot trade anymore. You can't take any more trades once you hit that risk limit. Now there's a couple of ways you can set risk limits. Now some firms, even prop firms, will set it in different ways, and your brokers will set it in different ways if they support it. Now if your broker doesn't support a risk limit for the day, you have to make sure you shift to a broker that does. I know Infinity Futures does support it, and I'm pretty sure Global Futures does as well. There may be some other brokers that may support that as well. So if your broker doesn't support a risk limit for the day, make sure you shift to a broker that does. It's an absolute essential as a trader. All professionals have risk limits, and there's no reason why just because you're an independent trader trading your own capital doesn't mean you should have a risk limit. You should, and it's an essential part of your trading plan. Generally, you don't want to risk more than 1% per day. Now, you might want to risk more than that as you get better, but generally, I don't think you need to. I don't feel you need to, especially when you are starting out and you are still, or you have been trading for quite some time, but you are not consistently profitable. Don't trade or risk more than 1% per day. So if you have a $50,000 account, don't risk more than $500 per day. If you have a $20,000 account, don't risk more than $200 per day, etc. Generally, you want to use about a quarter or half of that as the risk per trade. Now, there will be some schools of thought that will teach you to risk maybe 2% or 5% per day. And I think it's exactly that model that leads to a lot of traders that are new to the business just blowing out way before they've even had a chance. So, that's just way too much risk for day trading. 5% risk per day is too much. Okay, not until you establish yourself as a consistently profitable trader can you take that kind of risk. It's too much risk. So, you need to, 5% per day, 5 days in a row. If it doesn't work out, you're down 25%. It doesn't take long. So, use a really small amount of risk, 1% as the most, 2% maybe if you're better at trading and you have more confidence in yourself. But general guidelines here, I'm not telling anybody what to do, but do watch your risk. Always set a daily risk limit with your broker. If you haven't already done that, you should do that straight away. As soon as, if they're open this weekend, send them an email now, okay, or at the end of today. So set a risk limit and set it to be no more than 1% of your account. You will have drawdowns at times as traders, especially in the earlier phases. Sometimes you will have trades that don't work out. Of course, you'll have some trades that will work out. The way you've got to look at losses in trading and drawdowns is just the expenses. It's the cost of doing business. Okay, it's a normal part of the trading business. Not every single trade that I take works out. Yes, most of my days are profitable, but that's because I stick to my plan and I don't start ruining my trading day. And if it's not a good day, I generally don't trade. So that's how the discretion really helps out, and you can keep yourself out of trouble. Only really be concerned when you have drawdowns of more than 25%, and always stop trading live after 30%. Just general guidelines. I'll cover this in more detail. This is a basic risk management model, a spreadsheet that I put together. That I actually have these put together. They are on the Old Twisty members site. You guys, for attending today's seminar, or this weekend seminar, can attend. Join the Old Twisty members website. It's oldtwistymembers.com. So if you sign up there, I'll approve your membership and you can join. And this is posted up on there, but I will email it to you if you want it. There are 2% risk management models, 3% risk management models, but this is just a guideline. I'm not telling anybody what to do here, guys. I'm not saying that this is the only way to manage your risk, but I think it's just a nice, simple model, and keeps you out of trouble. Risk management is an important part of trading. It keeps you in the game, and it allows for you to get better at what you're doing whilst you are still in the game. So, just use an example here. Let's just say pretty modest account, 40,000 euros. Of course, this could be dollars or pounds, but you get the idea. 40,000 euros. Your daily risk should be about 1%, 400 euros. Your daily target should be a minimum of exactly what your risk is. But ideally, you want to risk less to make more for the day. So you want to target probably around 600 euros for the day, which is 1.5 times. Daily trades on the member site? No, they're actually on the blog. I only post them up now and again, though. I only posted them up for an example, as an example, last week. So yeah, I don't post up the trades. I only share them in the trading room, unfortunately. I'll post them up now and again on the blog, but if anybody wants to see what I'm trading and what trades I'm taking every day, it takes place in the trading room. But if any of you guys just every now and again want to know, if you're not a room member and just want to know, okay, Cam, I just want to, this is what I've done today. What did you do today? Just drop me an email. I'll send you my. I I keep a chart book. I keep annotations of all of my charts every day, and I'll be willing to send that to you if you want to have a look. So how does this break down? So if you've got a daily risk limit of 400 euros, now you can set this up so that you can only risk say 100 euros per trade, and now that will allow for you to take at least 4 losing trades in a row, which is quite a bit of playroom. Okay, you want to give yourself some playroom. You want to give yourself a little bit of flexibility. You can't go into the market expecting to just win and make money on every single trade. You've got to be willing to be able to take some risk in order to make some gains. Trading is very much about being risk takers, and I'll talk about this in the next few slides as we go on to moving on to the psychology of risk taking and being okay with that, and developing the winning trader's mindset. Now the other option here is, you could say to yourself, okay, I will be willing to take at least 2 losses in a row and then I'll stop trading. The key thing here is that you have some way to define when you should stop trading and when you've taken too much risk for the day. So you have a risk limit for the day, but you have a risk limit per trade. Most importantly, you stop trading when you've taken the risk limit for the day. Okay, once you've hit that risk limit for the day, you don't risk anymore. Taking more trades means risking more. Don't risk anymore on days where you hit your risk limit. That's the most important thing. That itself will keep you in the game and will give you a very good chance of making it in the business by just managing your risk and keeping your risk more. Now I've got a maximum account drawdown here. This is maximum. Okay, I'm not saying in any way that if you've got a 40,000 euro account that you're expecting, you're not going to stop trading until you're drawn down 12,000 euros. But that should be the max. That should definitely be a wake-up call. Okay. Now, the reason 30% is the max, if you look at drawdown and gain to recovery, meaning, now if you've had this level of drawdown, what do you have to make on what's left in your account in order to get back to break even? Okay, that's recovery. That's gain to recovery. So remember, gain to recovery is how much you have to gain in percentage of what's left in the account just to get back to break even. Now 5 to 10% drawdown, okay, it's just the cost of doing business. It's normal. Okay, it can happen. Not expecting anybody to have a 5 to 10% drawdown. Not in any way saying that you should expect that completely, but if it happens, it's okay. You should be okay with it. What I'm saying that is that when you get into trading, you have to be willing to take some level of risk, and you've got to define some kind of limit to that. You can't just take risk until you've blown out your account. Well, you can, but it's not a good way of going about doing it. So you have to take risk with the account you open. You never trade with capital that you can't afford to lose. Okay, so never trade with scared money. Always trade with money that you're willing to take some risk with. And it's just like any business. When you invest money in the business, you've got to take some risk to make some gains. And in trading, you have to. So that's firstly a given. You have to accept that. 20% drawdown is okay. Even if you get a 20% drawdown, it's about a 25% return, and you'll be able to get back to break even. But definitely a time to review your journals and trades and see where you could improve things. Maybe start looking for a coach or mentor to help you get through this phase and also overcome some of the obstacles. Okay, so that's more of a wake-up call. Okay, now 25 to 30%, this is where you generally have to start thinking about stopping trading and reviewing what you're doing. This is generally nothing to do with the method. Okay, most of the time when I've taken traders through the mentorship program, many of them will only have like a 5% drawdown and think something's wrong. Most of the time traders don't even go down to a 20% drawdown before they start thinking something's wrong. They will have one losing trade and they think things have gone completely wrong, right? Which is nothing. There is nothing wrong if you have one losing trade. Okay, it's just the cost of doing business. Okay, you might even have a down day. That's fine. It's fine. Okay, even I have them. Okay, it's fine. It's a normal part of trading. So, but what you do have to do is set a limit to it. When you say to yourself, okay, I've had enough of a drawdown now that I should stop trading. So this is more of a contingency. It's like, I'm not expecting anybody to sit here and say, okay, I'm planning to have a drawdown. That's not what it's about. It's about it's about business planning. It's about risk management. If you go into business, you've got to say to yourself, okay, doesn't matter which business it is. You've got to say to yourself, I'm going to invest this much in this business. I'm looking to make this much. I'm looking to gain this much. This are my objectives. This are my goals. But at the same time, if things don't quite go the way that I expect them to, or I anticipate them to, or I plan for them to, I need to know when to stop. I need to know when to look at my plan again and review things. And that's what I'm saying. So, do understand drawdowns and understand gain to recovery. You should at any point never ever go down to a 50% drawdown. If you've lost 50% of your account, it's going to take you 100% return just to get the break even. It's not saying it can't be done, but it's if you get into this area, you just shouldn't be trading anymore. You should stop trading, start looking at ways to improve, and look at where you're going wrong, and start working on your psychology as well. Okay, most of the time it's nothing to do with the method, nothing to do with the way people are trading. A lot of the time it's just down to better trade management and having more belief and confidence. Right, we'll move on next, but let's just leave this there and have another quick 5-minute break. Any questions so far, guys? No? Okay. Let me ask another question. Is it all making sense so far today? I mean, we haven't really covered anything that's that difficult to really understand. A lot of this is quite simple stuff, but very, very important stuff. Good. Excellent. Right. Thank you very much, guys. It's nearly 8 p.m. GMT. Should be able to finish within the next hour, I should think. So pretty much right on time in terms of how things are going. So we'll have a 5-minute break and we'll be getting back straight to it once we get back. Right, guys, let's get started again. Okay, so just a review that we've covered most of the steps 1 to 3 of the Ultra game plan, which is firstly developing a good understanding of the market using the auction market theory principles, understanding balance and imbalance, understanding acceptance and rejection. And then we moved on to step 2, identifying the opportunities using the volume profiling tools. Again, applying the concept of acceptance and rejection using high volume and low volume. We then looked at Fibonacci to establish areas for doing business on range extensions. And we also looked at divergences as a heads up for potential reversals. And we also looked at the use of the VWAP, the volume weighted average price, and its first and second standard deviations. We've then moved over to step 3 of the game plan, which is visualizing the risk to reward in a trade before you take the trade. So before we get into any opportunities, the key thing we have to ask ourselves is it worthwhile me getting involved in this trade? Is it worthwhile me taking the risk in this trade? Because every trade is a risk. Every trade that you take is a risk. There is no guarantee that the trade will work, and there is no certainty in the trading world. There is no certainty. You can gain belief and confidence that certain things happen more often than not, but nothing is 100%. Nothing is guaranteed, and there is always that level of uncertainty. So you have to go into each trade understanding that you may be wrong, but at the same time with the belief and confidence that you might be right. And the belief and confidence comes from understanding the market structure really well and understanding how the auction how the auction actually facilitates trade and how the market participants usually do business around the auction's market structure, around value, around balance, and understanding the stuff that we talked about, acceptance and rejection. So we have a lot of things that we can use, a lot of tools that we can use, and a lot of ideas that we can use to help put the odds in our favor that the opportunity that we're looking at will play off. But at the same time, it's a high probability opportunity. It's a high probability opportunity, but it's never 100%. So there's always a risk involved. So it's important that we manage the risk and we fully accept the risk. Like I said, the more you trade this way and this style, and the more you see the trades playing off time and time again, for some of you guys that are new to it, you have to see it happening. You guys that are in the trading room see it every day. You see it being traded around every day. And that helps you build belief and confidence in it. So there's three main areas you have to have belief and confidence. Firstly, in your method. Secondly, in your ability to trade that method. And thirdly, in yourself in general. As a trader and your ability to trade as a trader. You've got to have some belief and confidence in your ability. You have to believe in the method. It's not in the same way that you believe in the system based upon the back test, because this is not something that you just back test. The way you gain belief and confidence in a discretionary trading methodology is to, well, firstly, it helps to know that somebody else is trading that way, like myself and others, and it works for them. But more importantly, that you can actually take the ideas on, understand them and apply them, and at least start to gain some consistently profitable results yourself. There is nothing better than actually becoming consistently profitable yourself, or at least beginning to see the potential from trading this way. Now that's the start of it. When you start seeing the potential, a lot of that will just come from looking at the market trading. You don't necessarily even have to trade it initially, but when you start trading it in simulation, and then trade it small with a live account, and then you get bigger and bigger and bigger as you get more and more confident. That's what I've done myself in my trading. I started small and I've grown over time, and that's, I think, the same in any business. You have to do the same. You have to start small and then grow over time. And like I said, everybody is at a different stage in their career right now in this seminar today. So each and every single one of you, you've got to ask yourself, how do I move forward with this? Now, part of this is developing the right mindset, and it's a big part of it. To be able to trade successfully, I'm sure most of you guys know that a lot of this comes down to psychology, trading psychology, your own psyche. How are you thinking? How well do you control your emotions whilst you are trading? So, I'm not going to do a full seminar here on, understanding how the mind works and the unconscious mind, and how to actually deal with negative emotions, etc. But I will tomorrow be sharing some of the things that I use, and I will give you some practical steps to go away and do tomorrow. But right now, I just want to discuss, as we're talking about getting into the trade and we're talking about risk, I think it's an important time to cover risk and the psychology of risk. Firstly, I would highly recommend that you guys invest in purchasing a book which has been highly influential in my trading, and it's by Ari Kiev. Most of you guys probably have it because I've mentioned it so many times. Ari Kiev, that's Arikiev, and if I can find a link to it quickly, I'll do that now. And it's The Psychology of Risk, Mastering Market Uncertainty. And there's also another book, Trading to Win, by the same author. This is .co.uk site, but you guys can find it in your local Amazon or bookshop if they have it. That's The Psychology of Risk. but that will take you to the Amazon.co.uk site, which is what I use, and there's a Trading to Win. Now, the reason I recommend those books is because they've been highly influential to me and my trading, and developing the right kind of mindset. So, trading is very much about mastering market uncertainty and understanding risk. It is all a part of the business. And Trading to Win is very much focused on a little bit of what I'm going to talk about today, is shifting from a trading not to lose mindset to a trading to win mindset. And most traders will approach this from a trading not to lose mindset. Okay, and I'm going to cover some of the characteristics of both, so some of you guys may be able to see where you fit right now in some areas. Okay, so we all have to shift to a trading to win mindset. We all have to shift to a trading to win mindset. It's essential for all of us to shift to a trading to win mindset versus a trading not to lose mindset. We must all accept risk, but at the same time, we shouldn't become overly risk seeking. Sometimes I deal with traders that are risk averse. Sometimes I deal with traders that are more risk seeking. Both of them can do damage to the capital. So we will have a look at that. One of the most important things you must do in trading is fully accept your risk, and that's why I covered account risk management just a little while ago. Don't risk too much when you're first starting off. It just makes the trading game easier. It makes it easier for you to accept losses when you do have them. It makes it easier for you to accept a losing day if you have it. Okay, so this is especially for some of you traders that are new to this, or are still to become consistently profitable. Drop your risk. Take less risk per day. It becomes easier to tolerate. Okay, everybody has a risk tolerance. For me, it might be more than others. For some of you, it might be more than me. Okay, so each and every single one of you are different. You've got to ask yourself, what is my risk tolerance? What am I actually willing to risk out of my account as a maximum drawdown? What am I willing to risk per day as a maximum loss? What am I willing to risk per trade as a maximum loss? Establish that and then trade around that and accept that risk. Fully accept the risk. You can't move forward unless you fully accept the risk. You have to be willing to take some risk and make it risk that you can accept. If you can't accept the risk, it's probably too much. So if you're saying to yourself, okay, I want to risk $1,000 per day, but when you lose $1,000, it hurts you and you don't like it, and you really take it a bad way, then it's probably too much risk. Okay. Now the thing is, the human psyche, we don't like to lose. It's a natural way of being. We've all been brought up that way to not like losing. We're all taught since we're children. Losing is bad. Some of us learn that losing is even failure. On an unconscious level, a lot of us don't like losing. But in trading, having some losing trades is just a normal part of the business. It's natural to have a losing trade here and there. Okay, so it's important that when you're establishing the risk reward potential in a trade, and before you get into the trade, you fully accept the risk before you even pull the trigger. Otherwise, if you don't fully accept the risk, the first sign of the market moving against you, you'll get out. The first sign of profit, you'll get out. And this is all of the bad behaviors that we see traders commonly building. These are the habits that take them out of the game or cause them to have a lot more losses in the long term. So short term, you might feel that you're doing a good thing by getting out of the trade quickly or snatching at that profit. But longer term, it's actually a very bad habit. So understand short-term habits versus long-term habits. What is the impact of that habit on a longer-term basis? Not necessarily right now. You've got to focus on trading to trade well. Understand what trading to trade well is in line with your model for trading. Like for me, trading to trade well is taking the risk above value, understanding what my risk area is, and staying with that trade and keeping for the right reasons. If I see a reason to stay with the trade, not getting out of that trade, at least until my premise for that trade is over. As long as I can do that, I'm trading to trade well. And if I can stay with that trade and see it through to my profit objectives, my targets, I'm trading to trade well. Now that is versus trading to satisfy the P&L. If you are satisfying, you are trading based upon how much you are losing and winning, that's not performance focus. when you are actually trading, you can't sit there and think about winning and losing. You can't sit there and think about P&L, profit and loss. You've got to have a risk limit for the day and trade with that risk limit in mind and your objective in mind for the day, and trade in that gap between where you are and where you want to be. Let your risk management plan look after your expenses and any losses. So like I said, set a risk limit for the day. If you're going to have any losses, it's okay, as long as you don't have any losses that are greater than your risk limit for the day, and as long as you're not hitting your risk limit consistently day after day, there's no problem. There is no problem. 1% is easy to take. Even if you have 2 losing days in a row, it's only 2%. You can make that back in one day if you stay focused. So set risk parameters that will keep you in the game and will allow for you to bounce back. Be disciplined and confident enough to take the right trades and manage them well. But the only way you can have the discipline and the confidence to stay with a trade is if you understand market structure. Okay, this is where typically traders that trade systems will find it difficult, because they only take the signals based upon the system's ability to make profit based upon the past. And if they backtest and they take the signal based upon what's happened in the past, they take the trade right now purely based on the system because it's a signal. But if they don't know what to look for to stay with the trade, and they don't know what to look for to get out of the trade, they may well end up ruining that opportunity. But that doesn't only go for system traders, it will also go for discretionary traders. So if you don't have the confidence to stay with your trade when you've gone into the trade, and you don't have the confidence to take the heat when you should take some heat, because the trades don't always go in our favor when we get in. Now I'll show you some techniques tomorrow that will help increase the odds of the market moving in your direction by using order flow, but it doesn't always happen that way. Okay, and when I move into tomorrow's stuff, I want everybody to understand it's when we use order flow, it's not about becoming perfect. We've got to allow for those imperfections, and I'll show you through trade management how you allow for that. But you must be confident to pull the trigger. You must be confident to stay with the trade. At least until there's a clear reason to get out. The other focus should be on creating good trading habits. Most of you guys that have been on mentorship programs with me, or are on a mentorship program with me, or started a mentorship program with me, will know that the focus is on creating good trading habits, creating discipline, because and also taking the focus off profits, taking the focus off making money, because making money is actually a byproduct of actually creating good trading habits and creating discipline. Once you have discipline and you have good trading habits, the money starts to flow, the profits start rolling in. It's the bad trading habits that you got to watch. So focus on creating good trading habits, and of course you got to know what they are, and I'll cover more of that tomorrow. But we'll also cover some of that right now as well, some of the characteristics of trading to win mindset. So I spoke about trading not to lose. There's a big difference. Trading not to lose is a trader that is risk averse. They get into a trade, but as soon as they get into the trade, they're automatically straight away thinking, okay, I don't want this to not work. Okay, I don't want this trade to foul. Now that's that itself, that way of thinking makes trading very difficult, and actually most traders approach it this way. Okay, so if any of you find yourself, I wouldn't be surprised if any of you guys are finding some similarities here in the behavior, but it's okay. You got to recognize it first. You got to be aware of it first before you can shift it. So the important thing is here is to recognize if you're trading not to lose, and shift more to trading to win. And you might even find that you have recognized that you're trading not to lose, and you are willing to shift to trading to win, but you have to make the shift, and that's okay. Sometimes you may even go back to trading not to lose, and then you have to recognize that and become aware again, and then you have to go back to shifting back towards trading to win. So there's two kinds of mindset that really come into play here when you're traders. There's a trading not to lose mindset. Okay, so these are traders that don't want to lose so much that they actually end up losing. Okay, so they focus on not losing. That's their main objective. I don't want to lose. I don't want to lose because I can't stand the sight of losing. I want to trade, but I am not risk seeking. I don't want to take any risks. Okay, so this leads to, you know, not taking trades, etc. Always looking for certainty. Let me just read through this actually, because a lot of it's just talked about here. It's all here right in front of your eyes. What does it lead to? Trading not to lose. It leads to using tight stops to prevent bigger losses, mainly out of the fear of losing. It's okay to tighten your stops in order to manage risk in a trade where you feel risk may become greater than you should be accepting. But if you are still within the context of your risk area and you are still in a trade where you should be accepting risk and you should be okay for you to watch the market move against you in that area, you've got to accept it. You don't start moving your stops and start trading your stops as soon as the market moves a couple of ticks in your favor. You know, and that usually leads to them, the traders that are doing that, getting stopped out too early, and they end up actually achieving what they don't want to achieve. So they don't want to lose, but what happens is because they're trading not to lose, they actually end up losing. Okay, so this is important to recognize if you end up doing any of this. Snatching at profits, the fear of a certain profit becoming a loss. So, you know, they're in a trade and they see that, okay, I can take 10 ticks of profit right now, for an example, but, you know, if I hold on to this, it might turn back against me. It might come back to break even. It might turn into a loss. So I better take it right now because it's a guaranteed win. And this is now, you know, it's that mindset where you want that certainty. And the certainty, looking for that certainty because it's there right there and you can take that profit, you will take it. Okay, if you're looking for certainty, you'll end up taking it. But actually, you've got to embrace uncertainty. You've got to be willing to take the risk for greater gains. Sometimes it pays off, sometimes it doesn't. But longer term, it pays off. I know that because that's what I do. Sometimes shorter term, you know, some of you guys saw that this week. There were some trades that I took that didn't pay off. Okay? Because I took a greater risk. But some, more often than not, that taking that greater risk actually pays off. And that's what I'm more interested in. Snatching at profits because of the... that's what I just discussed there. Okay? Holding on to losers with the inability to accept a loss, even after the reason for being in the trade is over. Now, it's okay to hold on to a trade that's not working out as long as the reason for being in the trade is okay. It becomes a problem if you hold on to a trade that's clearly over and the reason you got into the trade is clearly no longer intact, the premise for being in the trade is no longer visible, and you still stay with the trade. You know, that then is an issue. Traders trading not to lose are usually fear driven rather than driven by their vision or objective. They are driven by past experiences which could cloud the present moment and actually what is really happening. So they see something that's setting up, it looks great, and all of a sudden past memories start flashing up on the mind's eye, and they start seeing things that happened in the past, and they start to develop a fear that it might happen again. They may have had a bad past experience, a bad trade that didn't go too well, and then they start looking back and all of these flashes of images, movies start playing in your mind's eye. And some of you guys have probably recognized this. You've sat there, you're trading, and all of a sudden images and movies start playing from past experiences, and then all of a sudden it clouds your judgment in the present moment. Okay, and it's important to deal with that. I'll be sharing some techniques tomorrow, of course, so this is just covering the mindset and the characteristics of it. I'll share some tools and some techniques tomorrow. Looking for certainty, like I've established. Okay, they're always looking for that certainty, looking to satisfy the ego rather than the business. Okay, so they are scared that they may have a loss, and that may affect how they feel about themselves. So rather than to satisfy the actual business objectives, which is probably to take that risk and actually embrace it, they will be willing to just get out of that trade, let go of it prematurely, or try their stops too aggressively, etc. Trading to satisfy the P&L rather than trading to trade well. lacks the patience to wait for the right trade and trades to satisfy the need to trade rather than the need to win. Okay, so they're trading for the sake of trading, which I call trading for entertainment traders. They have to take a trade, and I've said this in the room before. Okay, yeah, there's stuff to do here, but it's not in line with my plan. I'm not going to take a trade here today if it's not in line with my plan. I can take 4 to 6 ticks here, fine, okay, but it's not my plan. It's not my objective. So, you know, when you end up taking trades purely because it's just a quick buck here and there, you do that to satisfy the need to trade rather than to win with your main objective in mind, your business plan objective, your trading plan objective in mind. Lacks the patience for winners to play out or offside trades to work out. So the trade might go a little bit offside. It may not be working out for you right now while it's open, but you've got to suffer some adverse excursion at times. Adverse excursion is when the market goes a little bit against you before it moves for you. And then favorable excursion is sometimes when it moves for you, but then moves a little bit against you. That will happen when a trade is open. You've got to ride that out, especially if you're looking from a longer time frame perspective. You've got to, the only way you can gain confidence to do this is if you understand the structure and you believe in it. That's why step 1 of the game plan is so important, because if you don't understand the structure well enough, it all affects the way you think and the way you do things. The ability to stay with a trade and give it the time and the patience to play out all comes back down to understanding structure and what you think and believe may happen based upon what normally happens. Now, you might be wrong and you'll accept it, but at least you'll know what to see once you're wrong. You'll know what to see and you'll know when to exit because you are wrong. Now, a trading to win mindset is a little bit different. This is what we all should be trading with. This is what I focus on establishing each and every day of my trading career. This is why I do what I do as a part of my daily routine, which I'll share with you tomorrow, to ensure that I stay in this way of thinking. I stay with this mindset, trading to win. I have to stay engaged with a trading to win mindset rather than a trading not to lose mindset. The only way to establish that, first of all, get some belief and confidence in what you're doing. Understand the market really well. That will then allow for you to embrace your risks. It will help you focus on winning. It will also allow for you to clearly define a goal and objective. You can sit there if you understand market structure and say, I expect the market to go from here to here. I understand this is my risk area. I'd stay confident with this trade at least until that's broken. You trade in the gap between where you are right now and where you want to be. It's trading in the moment. You're committed to the vision of achieving a goal. Like I showed you earlier, I will visualize the trades way ahead of me even thinking about taking them. I will visualize where the market may go from and to. I'll then stay committed to that vision until I'm clearly wrong. I'm not going to get out of a trade and just because it moves a tick or two against me. Okay, I will embrace uncertainty. I will embrace the market noise as long as the reason for being in the trade is still valid. I will have belief and confidence in what I am doing. Okay. We'll have patience for the market to play itself out and wait for the right opportunity to set up. So if I'm waiting for an opportunity for the market to get above value and it's trading within value, I'll do exactly that. I'll wait. I'll be patient. I'll wait for the market to come to me. A lot of the time the market opens up, it's already at a fair price. I'll say, okay, these are my levels. I'm going to sell it if it comes up here. I'm going to buy it if it comes down here. If I buy it here, I'm going to expect it to go to here. These are my profit targets. If I sell it here, I'm going to sell it here. These are my profit targets. Okay? Establish well in advance. You've got to have some confidence in that. You've got to give it patience to set up and take that right trade at the right time. And most importantly, you focus on trading to trade well. You focus on building peak performance and focus on building better and better in performance each and every single day and every single trade you take. And as I said earlier on, create good trading habits. So, that's the difference there between trading not to lose and trading to win. Does anybody maybe recognize that they fall under one of these categories at times? Maybe not all the time, but you recognize this stuff. It's all trader stuff. Stuff that we all go through as traders. But what I want you to recognize is, if you are trading not to lose, that you need to start shifting to trading to win. And these are the characteristics that need to be a part of your mindset and the way you are thinking and doing business. Right, does that make sense, guys? Yep, good stuff. Okay, so some of you guys are probably thinking, okay, how do I go about shifting from one mindset to the other? Well, the next slide, I've basically just broken down. Some of this stuff is taken from the blog, okay, because I put up an article on this, and you guys will find that on the blog, trading to win versus trading not to lose. And I actually put this up as an answer to a trader, an individual that actually had a question. Okay, I understand from a conscious level that, I might be trading not to lose, but I need to shift to trading to win. But how do I go about doing that? And I'm very much about, giving practical information. How can you go away and actually, okay, fair enough, I know that's not what that's what I know I shouldn't do, and this is what I should be doing, but how do I actually go about doing it? Tomorrow I'm going to give you some more tools, but this is basically what it breaks down to. These are some simple things you can do, nothing complicated, very simple stuff, and sometimes the simple stuff is most effective. Each and every single one of us can sit here and do each and every single one of these steps. Step 1, clearly define your risk per day, as I said earlier. So you know what you're willing to risk. You're willing to risk that. You're willing to lose it if it happens to be the case. Okay? Of course, you're not going out there looking to lose, but if it happens, you'll say, okay, I accept it. It's okay, let me move on to the next trade. I will have those losing trades. Each and every single one of you will. Okay? Just keep them small, move on to the next one. Most of the time, you'll make it back in the next trade. But that's if you stay disciplined. Okay? So know what you are willing to risk if things don't go well. Embrace risk and love it because it's all part of the game. Clearly define your goal objective for the day. Really important. Like I said, generally 1 to 2% of your account as a goal is good, and don't risk any more than that. Matching the risk with the objective is a good idea. So if you risk 1% of your account, aim to make 1% per day. Okay? Of course, your objective then will be to make that 1% more often than you lose your 1%. Aim higher, even better. Aim for 1 to 2% of your risk per day. Aim to make more than what you risk per day. Not per trade, I'm talking about per day here. Never take more risk than you can afford to take with your account. I usually recommend traders take no more than 1 to 2% of their account on any given day. Like I said, ideally you want to trade with less risk. When you're starting out, you can take more risk as you grow. Start off with very small risk. 1% is about as much as you would want to risk as a day trader. If you hit that risk limit, then you stop trading. It's as simple as that. Otherwise, until that happens, you must, keyword must, stay fully engaged and focus in reaching your objective or goal for the day. And consciously try to trade well whilst following the plan to the best of your ability. So it's okay to say, you've had a losing trade. It didn't work out. It's the cost of doing business. Move on to the next one. But, bring into perspective your objective, your goal for the day. Bring into perspective the next trade, the next opportunity. What is the objective for that trade? Envision it. Understand where the market may go from to. Let that motivate you to take the next trade. Let it motivate you that you understand the market really well and what you generally expect to happen does happen. Now, it might take time for you to really believe that. Now, I believe it because I see it all the time and I do it all the time. But you have to believe it yourself. Visualize your day and how you plan to trade before the market opens up. I'll cover a little bit more on pre-market analysis tomorrow and how I go about doing this. And with each opportunity, visualize in your mind's eye, very similar to what I showed you earlier, what you want to see if you are right with your trade idea. But also know what you don't want to see in advance so that if things are not working out, you know when to get out and you know what you need to see when you need to get out. Embrace that the market is uncertain at all times. There is no certainty in this business, so never look for it. Never look for perfection or certainty. Embrace that uncertainty. That's what the business is all about. Fully accept that every trading opportunity is just an idea. It can just as easily be right or wrong. You have to do that. You have to understand that each trade you take must be right or wrong. I basically talk you guys through this every day in the room. When I take a trade, I'll say, look, I'm going to take this. This is what I'm expecting, but I might be wrong. And you have to be humble about it. There is no ego in this. Okay, you've got to be humble about it. You've got to say, okay, this is what I'm expecting, and most of the time it comes off. Right now, I don't know if it's going to happen, but let's see what happens. I have confidence in it because it happens more often than not. Okay, I have a good enough reason to get in. I've done all my homework. I've seen the order flow it sets up, tells me to take the trade. I know what my targets are. I know the risk is smaller than my potential reward. Let me take the trade. Okay, so you get in and you do the best you can. Okay, we all know, cut your losses and let your winners run, right? So if the trade's working out, you trade it the best you can. If it's not working out, you start cutting your losses. An old adage, but very important to practice. That's the most important thing. You know, there's another thing knowing that, you know, you should cut your losses and limit your risk, and you should ride your winners and maximize your profits. But you know, it's another thing actually doing it. So you have to develop this trading to win mindset, so you do actually end up doing it. Continuously build belief and confidence in your plan and the concept and ideas that you trade. And this is where everything that I've covered today really helps, because it helps you understand what should happen. It makes logical sense. It's common sense. If you understand the market and the auction market 3 principles, it makes sense for this stuff to play out. So you've got to have some belief and confidence in that. Belief and confidence in your concepts, your ideas, the opportunity that you are about to take a trade with. Okay? I fully believe in the auction market 3 principles and the power of volume profiling, as well as the use of order flow. That's what helps me trade with the tools. So if you don't believe in the way that you trade, then it's difficult to make money. So you have to develop that belief and confidence in the way you trade. And a lot of that comes from actually doing it. You have to develop it as you have to develop some experience in actually doing this and seeing it work. Some of you guys will see that time and time again in the trading room, day in, day out, one day into the next. You'll also see times where it doesn't work out so well, and you see how I handle it. And most of the time it looks after itself. You know, I very rarely have a losing day, and I'll have losing trades, and most of the times when I have a losing trade, it looks after itself as long as I stick with the plan. So most days, if you stick with the plan and you trade this way, it looks after itself. Okay? So that's the most important thing to understand, though. You've got to understand that the confidence comes from knowing what works based upon the auction market 3 principles, because at the end of the day, we're trading the market and what the market wants to do, not what we want the market to do. The market's job, going back to the beginning, is to facilitate trade. And if you are trading a model that is designed around fulfilling the market's purpose, that itself is a great edge. Right? Now, of course, you do need to understand, once you've identified those opportunities and you have that level of understanding, how do you get in? And once you get in, how do you manage the trades? And this is what we're going to cover tomorrow. And then I'll also be moving on to planning, preparation, and performance and feedback. So, well, on that note, actually, that pretty much brings us to the conclusion for today. And I'll open up for questions and answers. Lots to go into tomorrow, but today is a solid foundation for it. I hope you guys enjoyed it. It's been a pretty long day, lots to take in. Nothing too overcomplicated, and I don't want to overcomplicate any of this because it is quite simple, really. So, questions and answers. You guys give me the questions, I'll give you the answers. You can ask me questions about anything that I've covered today. But if I've done a very good job and it all makes sense, we'll continue. We'll close up for the day. We'll come back tomorrow, and maybe you guys will have some more questions tomorrow. So I'll just turn off my mic and just wait for some feedback. Or, you know, if you've got any questions, if you haven't got any questions, just give me some feedback. What did you think about today? What did you learn today? Did it make sense? Did it not make sense? Was it totally a waste of time? What, you know, tell me what you think. But tomorrow obviously is going to bring a lot of this together. We're halfway there at the moment. Thank you very much, Dave. Yeah, I mean, that's what it's all about, you know, explaining the theory and reinforcing the basic principles, because actually you don't actually need more than that. That if you can apply those basic principles, that's exactly what I want you guys to understand. You don't need to know anymore. That is all you need to know in terms of the basic principles. If you could take that away and apply that, that's all you need. Okay. Now, of course, you need to know how to get into the trade and understand what you need to see when you want to get into the trade, which I'm going to cover tomorrow, and also you need to know how to manage the trades. So that that is the next step. But for the purpose of understanding what is actually going on and understanding where is there an opportunity and what context am I trading within, where am I expecting the market to move from and to, should be understood from what you've already learned. And what more do you really need to know if you're about to take a trade? What more do you need to know about the market than, okay, the market may go from here to here because of this? You don't need to know much more, right? Does everybody agree? That's what you need to know. You need to know the market should do this because of this. It makes sense. So, we don't need to overcomplicate it. Let's keep it simple, and let's now move on to the next step. How do I get into the trades and how do I manage them? A lot of it, comes down to trade management. Trade management is what gives you the result. But you don't need anything else when it comes to identifying an opportunity. You got your key areas for doing business. It makes sense. You know where the market may go from and to. It's logical. It makes sense. And that's what you need. And that's what you have to believe in and build confidence in. I believe in it totally. And it's now your job to believe in it as well. Right. Okay. It doesn't look like we've got any questions then, guys. So we'll finish up for the day. Pretty much right on time. And hope you guys enjoyed it. I did, and I will see you guys tomorrow. So remember, tomorrow some of us will observe daylight saving changes in the US. Most of us are not from the US, but some of you guys are. So you guys in the States are observing daylight saving changes, and I believe you spring forward with your time. We in the UK here do not change our clocks until the 25th. So I am still sticking to the GMT time, so I am opening up at 12:45 p.m. GMT, and we will get started promptly at 1 p.m. GMT, and we will probably end up finishing around about the same time tomorrow. But quite a bit to get to tomorrow, and we've got a lot to get through. So, and often the second day is the most fun day, because most of you want to cover the order flow stuff. But like I said, order flow doesn't make any sense unless you understand the basic principles. Because when it comes down to order flow, if you don't understand pricing and how it works, fair prices, unfair prices, it doesn't make a lot of sense. And balance and imbalance, of course, as well. Right, okay, good. Thank you very much, guys. Thanks for joining in, and we'll see you tomorrow then. Have a good evening, good day, and we'll all catch up tomorrow.